dance perfectly, manages not to upend anything at all. The total shift in cumulative policy expectations by year end have moved a grand total of 4 basis points since the beginning of the week. Just an expert dance from Jay Powell. Just incredible. He had to not rock the boat, and he was perfectly still. So we have now what to go back to. If the market thought that all of these things would be encouraging, we'd be seeing a rally. If the DeepSeek situation were resolved, or even if it were possible for it to be resolved within a few days, as though it's some sort of an event rather than a course shift, that's certainly not occurred, or the markets would be surging. So what are we left with? I think we're left with the de facto ex ante before macro risk. That is to say, we are back in an uncertainty of AI deployment kind of a story with not much else to show for risk sentiment to glom onto as a catalyst. That feels like we're probably in for a rocky day to end the week tomorrow.
Dylan, the NASDAQ has recovered here a little bit over the course of the week. It's now down by 1.3% week to date. It's certainly not the 5% loss that we were looking at at the lows on Monday morning. On Monday, we were talking about, and we've been talking about this all week, if we were to assume a basket of what phase 2 names would look like, for those that weren't here for earlier episodes, names on that list would be, in this particular basket, we've been watching Amazon, Meta, Google, Palantir, Snow, S&P Global, FactSet, FDS, IQVIA, UNH, and Axon. That basket's up 3.16% this week so far. Dylan, are we just moving the chips around the table right now as we get ready for phase 2 of this AI super glide?
I mean, I think so. I mean, but it's obviously this is probably the most debatable topic on Wall Street at the moment. So, everybody's got their 2 cents. But that's why I was so bold. I think Apple is one of the greatest beneficiaries of second gen AI or applied AI or device-based AI, more efficient AI, which is why I'm optimistic. I don't care what their numbers are for the most recent quarter, but I'm super interested in how they characterize their forecast. And if they make any reference to the collapsing cost of applied artificial intelligence, because I think that Apple, you brought IBM to my attention, which I honestly hadn't even thought about until you brought it up for me yesterday. And I just think Apple's right there. And I think the Apple chart shows that. I mean, if you look at whatever that DeepSeek news was, that was more or less the bottom in this most recent sell-off in Apple. Apple has all kinds of problems, right? In terms of, it's like Tesla. Like, is Tesla trading based on car sales or based on, its business fundamentals? No, it is not. It's based on the billionaire owner's proximity to the president of the United States and promises of the future. Is Apple at this point trading based on Apple iPhone demand? To a certain extent, certainly more than Tesla is trading on Tesla demand. But I do think Apple's in a really good position to exploit future expectations for their success as it relates to applied artificial intelligence. And so that's why I love Apple so much at this moment. Because I think that they're the biggest of the Valley crowd. I think they're in the best position for next gen AI, meaning applied AI, device-based AI, distributed AI.
I actually agree. I don't think there's anything about that story that doesn't make sense to me. For me, the question isn't that story. It's, does risk sentiment allow for that sort of differentiation to occur, or are we just going to go into a risk off mode generally, and so everybody gets hit at the same time? And that seems like the clear scenario. I think that story will matter and will be a reason that Apple outperforms, just maybe not here and now.
Tesla here today, it's up 2.87% as we look in and settle in after earnings. We see that we gap open higher, but we give back some of those gains over the course of the day. It's been a lot of chop for the past 2 weeks for Tesla. My vested interest for Tesla comes vis-a-vis XLY because it is the single largest I think it's product and discretionary here these days. 233.20 here in discretionary. The position that I have had on for a few weeks now since the middle of the month when we started to break out was long the 240, short the 250 call spread. So that's nice progress towards that today as I'm looking for a return back to the highs that we saw at the end of last year. And it's along the line of that thematic idea that the economy is still doing well. So you mentioned the GDP report this morning, Ilya. I think it's worth exploring perhaps why we saw the GDP report do what it did, or at least turn out with the numbers that it turned out with. So we have a breakdown here of the contributions to GDP right now. And one thing I couldn't help but notice in this contribution breakdown is the fact that this purple area corresponds to private inventories. Now, one of the quips that people have had in quarters past, particularly just 2 quarters ago, was that the GDP number was kind of hollow. Why? Because inventories were a big part of it. If you're building up your inventories, you may be considered to be borrowing from future growth. There's going to have to be a give back period where companies sell everything on their shelves, right? They're not going to keep stocking up their inventories. So you have an inventory drawdown cycle. And we just may have had that here. And we still had a positive GDP number. So you strip out the impact of inventories right now, all of a sudden GDP is closer to 3.2%. And PCE is at its highest contribution that we've seen since the first quarter of 2023. So the American consumer right now is really, really strong. At least
strong consumption, by the way, since early 2023 as well. That's actually the interesting thing about this. This was the fastest consumption growth since the first quarter of 2023, and I believe the 4th consecutive increase. So it's been accelerating every quarter this year or last year. This data to 2024. So to your point, very strong consumer, and it's the same reference point for the decline in investment. Investment, the biggest demerit also since January 2023. So same starting point, very different actual outcomes depending on whether you look at consumption or investment. And in contribution terms, almost the same kind of a breakdown here. 2.8% was consumption, and then if you add up everything else, it's essentially negligible, but for a 1% shave off on investment, which is mainly inventory.
Well, right. And so, can we look at the investment and say, well, what's going on with rates? Rates have jumped higher here over the the fourth quarter. The Fed cuts rates in September, and then for the rest of the quarter, rates are trending higher effectively. But, and are the reasons why consumers spending money, are they for good reasons? Or are they just putting everything on plastic and hoping that credit card rates fall in the future? I mean, we've seen auto loan delinquencies, credit card delinquencies tick up in recent months. So we can't discount the fact that people are they're using debt to sustain their lifestyle. Savings, obviously, they're low these days, lower than they have been post-pandemic because people have been drawing them down. But nevertheless, the rotation here today, banks up by 0.98%, outperforming the broader market. Consumer discretionary up by 0.97%, outperforming the broader market. And hey, even semis, they're trying to stick their head back above water, up 2.35%. And this probably sets up the most important, at least from my perspective, technical test of the entire week here now, because we obviously have that big gap and breakdown. We lose the uptrend from the August, from those late December and now early January swing lows. We're back to that level here today. I know you're not a fan of diagonal trend lines, Ilya, but I like to play around with them. We close right at that 1-week moving average. We run into it as resistance. We can't climb through there just yet. So is this a dead cat bounce? We probably have a better answer to that question for semis tomorrow. And quite frankly, it feels like the market is digesting the DeepSeek news and not necessarily getting too worked up over it. It's figuring out that, hey, if this is really what is going on, then the futures here are getting here faster, and we still probably need to do a bit more CAPEX build out in the short term for these inference capabilities. Dylan, are you surprised in your esteemed career as someone who's watched markets, participated in markets, talked about markets, written about markets? Are you surprised that we haven't seen a more negative follow through here in some of these semi names this week? given the reaction?
Yes and no. I feel like part of it is I think there's still a reasonable degree, and I think understandably there's still a reasonable degree of skepticism as to the actual story, as to the amount of resources necessary for DeepSeek, or the degree to which the DeepSeek product harvested other resources from other people, other open source or otherwise resources. So again, I think the skepticism of the $6 million number is well founded. If only because it implies that there may be, what all the things it implies. Also, I think that the beautiful thing about a well-defended monopoly and control of the president of the United States, if you're a tech oligarch, is even if there is a better, cheaper mousetrap, if you have a really good, well-defended monopoly and control the president of the United States, which the tech oligarchs have a pretty well-defended monopoly in America and have total control of the presidency, that even if someone creates a better mousetrap, that their ability to prevent that mousetrap from being available is pretty high. So I think that it's a vote of confidence as to the stranglehold that the tech oligarchs have on their monopoly and on the president, as well as skepticism that DeepSeek was really a $6 million product.
I think this is probably maybe a lost in translation aspect of all this, but I want to share this blog from Dario Amodei. He is the CEO of Anthropic. He notes here, and this is a blog post that was put out yesterday morning, at least when I saw him tweet about it. He points out here how much it cost for them to actually train the models here. So if we go to that, the number he floats is about $13.5 million. DeepSeek does not do for $6 million what AI companies are doing for billions. Claude 3.5 Sonnet mid-sized model that cost a few $10 million to train. He's not going to give an exact number, because what he's talking about is how much money does it actually use for that particular training run. I think what the market has confused here, we've confused here in the reaction to invading the semiconductors, is that the entire project cost all in was not $5.5 or $6 million. It was that this particular training run was about $6 million. And the training runs that you're seeing from Anthropic, that you're seeing from OpenAI, they're costing tens of millions of dollars. They're costing $100 million. And so while there's scale there, it's not, well, they did this for $5.5 billion while it cost us $5.5 billion. How did they do it at, two magnitudes lower? That's not the case right now. And so there's a little bit of confusion here. And the people in the AI space who were really jazzed up about this, the Darios, the Andrej Karpathys of the world, back in December and early January, they're now kind of being like, hold on a second, the world has misinterpreted this. They're right to understand the model is going to perform at a high level, but the path that we took to get here, no. This wasn't just like a company was built with $5.5 million. It's this particular run that costs $5.5 million. And that, quite frankly, means you still need the infrastructure.
Which is billions of dollars of infrastructure to then run your little run on top of it, basically.
And I think a lot of people are walking away saying, well, it means the export controls don't work. Actually, I think it shows the export controls are more important than ever. At least that's probably the interpretation the Trump administration is going to take away from this with their penchant for tariffs. Because if you don't have the infrastructure long term, as these AI models get more complicated, you're not going to be able to get that next level higher per se. And so I think you're actually going to see a tighter effort, because if you have the best AI model in 2026 or 2027, you probably have a significant advantage over other countries and economies. And it wouldn't surprise me if, like, again, we brought this up, but if a small country like Angola had the world's best AI model tomorrow, that was AGI, China and the United States would probably invade that country.
Well, and this is the whole thing.
So this is a Cold War issue at this point in time.
Right. And you got to give it to the markets. Even when they are on shore in China with all of its peculiarities, let us say, the markets are undefeated. Because if China truly had produced a better model and it had truly lapped the US, there would be a rally in Chinese markets. And what there isn't is that. We've seen a slow oscillating back toward the top of a recent range. If you look at overall Chinese shares, ASHR, it's flatlined. So if there was really a shift in the balance of power, we've seen what happens to these markets when it feels like there is a shift in the balance of power. Look at what happened in September, October, when there was a whiff of maybe finally some fiscal stimulus in earnest to really start China's economy. Then, of course, it didn't happen. But it doesn't take much. If there was the perception that China will now come out of its slump because it has truly lapped the US on AI, markets would tell you that's not what this is, very clearly. And so, of course, now people come out and go, well, it's not exactly the same thing. It's not exactly the same cost. There's this consideration and that consideration. The market's already told you this as of Monday. The real question, to my mind, isn't, oh, is China leapfrogging the US? Of course they're not. That's ridiculous. What's going on here seems to be that you have the possibility now to say, hey, you're a smaller corporate that wants to deploy very targeted AI applications. You can do that with not so much outlay on space age chips and infrastructure. You can do it cheaper. That significantly changes the on-ramp for the industry as a whole. It opens up a different client base that has less money. It perhaps opens up a deployment to other economies that aren't as wealthy. It perhaps opens up a different sort of timeline to get from build out to operational out there showing ROI. And nobody knows what that's going to look like, and it's going to take months to figure out. But what we do know is that the on-ramp we had before, it now looks wrong. And I don't think anybody knows which parts of it are wrong. And I think everybody's going to be incorrect 10 times over in their prognosticating of what that is going to mean. And we're going to have this debate for a long time. But what we do know is that valuations for companies like, say, NVIDIA, bake into them an assumption of a path. And you can't assume that path anymore.
Yeah, the path uncertainty has increased here. Apple earnings are due out in about 4 minutes' time. Just a quick reminder of where we stand on this. The EPS estimate is $234 a share, revenues $124 billion. The implied move through the end of the day tomorrow, if we look at the one-day options, $8.75. It's about 4% plus or minus here. So it's not exactly a huge move being priced into this market. It's maybe up to 242, plus or minus $8. So we're talking about like maybe up to, 246, maybe down to 232. That doesn't necessarily clear out recent lows that we saw just yesterday, right? The low was 232.98. You could see just a drop to the intraday lows that we saw yesterday. That wouldn't be too significant. But if we do break out from here, you can see on a shorter term time frame, we've kind of run into a ceiling right around 240 and a half. And if we can break on through those levels, swing highs in mid-January up at 241.40, perhaps it means we are out of the woods here in Apple. And ultimately then if Apple's participating to the upside and NVIDIA is beginning to recover, then the NASDAQ all of a sudden is looking in a little bit better shape than it was just a few days ago here. The NASDAQ right now, obviously being pushed around by these tech earnings. Dylan, you mentioned IBM being a surprise to you. This is one of those phase 2 companies because of what they do. We talked about Watson X yesterday, an AI that makes AIs. An alarming concept, but it's the future, so we're going to do it. Is this now the company that should be on our watch list? Is this now the next company that's going to go from $200 to $1,000, Dylan? Is IBM
obviously it could be. I mean, the thing is, I think you're going to have the nice thing about the second generation artificial intelligence is it's actually a longer list.
It's not just mega cap tech.
Like it's maybe 1,000 names instead of 10 that could theoretically break out in a massive way because of success with applied AI. I think Ilya kind of hit it on the head, which is the only thing we know is that uncertainty went up, not down, as a result of DeepSeek, because it compromised the current narrative of sort of phase one, but really didn't answer any questions exactly about who's going to be the greatest beneficiary of phase two. So for sure, this company could be IBM, sure, could be Apple, but it also could be, the entire biotechnology industry. It could be the BTK as an index. It could be in material science. It could be DuPont. Could come up with some new non-toxic super material. The ability to do R&D in general. Anybody that's R&D intensive, or anybody that is data rich and user connected, are the obvious sort of locations for the highest probability of being a breakout on second gen AI.
And to your point, Dylan, we're probably entering a period where companies are going to start to announce that they have their own AI that they're deploying, and things will start rallying on that before those AIs produce anything, just on the idea that it's being rolled out. And it almost has the kind of thing where like Polaroid introduces crypto into their business somehow, and everybody goes, "Hey, Polaroid." DuPont comes out and goes, "We're rolling out DuPont AI," and everybody goes, "Hey, DuPont," just on the rollout itself.
It's like when Kroger did it. I know that we kind of I certainly poked fun at Kroger last year when they were doing, hey, we have AI in our earnings now, but it helped with inventory management, and Walmart told us how they're basically able to classify things much, much faster, saving tens of millions, hundreds of millions of engineering hours. So that's important. Apple earnings should be coming out any moment here. I'm waiting for them. I see the stock price is up a touch here. We'll go to that 5-minute chart, 240 right now as we look here for those Apple earnings, 243. Waiting. I'll let you know when they cross my screen. Feel free to let me know. 240 EPS, beating expectations at 234. Those revenues up a little bit more, 124.3 billion, beating the expectation of 124 billion. Can't say I'm unhappy to be wrong that Apple's moving higher here for those expectations in last call. We'll wait to see what some of the other information comes out as I wait for the full details of this report. But iPhone sales, there's that issue. iPhone sales were 69.14 billion versus the consensus forecast of 71.03. iPad sales were a bit stronger, though, at 8.09 billion versus 7.32 expected. Mac sales also stronger than expected, 8.99 versus 7.96 billion expected. So fewer iPhone sales, but more of the other products. The Greater China sales, this perhaps become the most interesting thing moving forward, considering we have to deal with the prospect of tariffs. Apple, 18.51 billion in net sales for Greater China versus 21.33 billion in those consensus forecasts. Any other thing else of interest here? Wearables, home and accessories, 11.75 billion versus 12.01 billion expected. So, look, the iPhone is the most important thing for Apple, right? That is their business, bread and butter. And they haven't been able to deliver on Apple Intelligence. We've talked about this a lot in recent weeks, months, that it was coming out. Would this spur the big, great iPhone upgrade cycle? And while it initially started to get some traction, Apple Intelligence has been a bit of a bust. So that really hasn't come together yet. Share price is relatively unchanged. We talk about it being a plus or minus 4% implied mood here. And so if you were playing an Ivy crush kind of trade right now, you're feeling pretty good about things. Apple, of course, isn't the only other company with earnings out here after hours. Visa, likewise, was expected to report. So maybe, just maybe, we've seen that come down the pipeline here. I'm checking, but please feel free to jump in. Ilya, do we need to be worried about Apple's China story moving forward with Trump giving us our 25% Mexico and Canada tariffs? China has to be around the corner, right?
You would think. He does seem to want to go talk to Xi first, and I think that kind of, I've mentioned before, and I think nothing has has really gotten me off this square, that the idea that they want to slow walk the TikTok thing seems to suggest that what Trump wants is some kind of a headline making grand bargain. That he wants to either show up in Beijing or have Xi come and meet him in Washington, roll out the red carpet, have lots of pomp and circumstance, stand there looking important, then have some kind of a big grand announcement to make, like TikTok is okay and tariffs aren't coming, but China's going to do this. I mean, recall what happened when they had the phase one deal that they did in the first Trump administration. And there was all this deal making to say, okay, well, we're not going to escalate, but you're going to do things like buy more soybeans and all of that kind of stuff. None of that actually happened. But nobody went and bought the requisite amount of soybeans. And it all just kind of got forgotten and fallen by the wayside, except perhaps by U.S. soybean producers. So when you look at sort of what you're likely to get here, I'm not so sure the tariffs are the path of least resistance. I think it's more like what there is a desire to do is a photo op that is going to sort of reduce the level of engagement. And I think that's what Beijing probably wants as well. I mean, they have their own problems galore. So they've been actually attempting to kind of tone things down. They've made some sort of tentative arrangement with India, with Australia. They're trying to with Europe. They're trying to, I think, calm things down. So I think when we look at the larger issue for Apple in China is that consumers in China don't want to buy things in general. They don't want to buy iPhones, but they don't want to buy things. Just period. Demand is really weak. This is how we keep getting these CPI numbers that are within 10 to 20 basis points of zero for months on end. This is how you get the GDP numbers that we've seen. They kind of juiced them up in the fourth quarter to hit their target. We'll see what they look like in the first quarter. I think that'll be much more telling. But what we certainly see is that the PMIs are anemic, pricing power is absent, and household bank accounts have record deposits because nobody wants to spend. Everybody's hoarding money. There's no demand. So the larger issue for Apple here is unless Xi Jinping finally decides that it's time for fiscal stimulus, they don't have much of an on-ramp here to see this improve.
Apple kind of pinned here, 237.60 right now. Trump a few minutes ago said that just in case we forgot that China's getting their tariffs too. So yeah, I'm with you though that it feels like it's going to be a little bit more deliberate, whereas he's just trying to push around Mexico and Canada right now because he knows he can.
Well, USMCA is coming up for renegotiation. To me, that all of that is this
posturing for this. Yeah,
all of that is this. The USMCA is coming up for renewal. Does he really not want to do that deal? Come on. This is the same thing as I'm going to tear up NAFTA. Okay. And then what? And then I'm going to sign a deal that is only marginally different, almost identical. Okay. Right.
Dylan, when it comes to trade, are the markets underappreciating the threat of tariffs, or have we just we get it, they're coming, move on?
Yeah. I mean, it's hard to really, that's a difficult question to answer. My sense is that the markets generally think that Donald Trump is catastrophically full of shit. And so until he actually does some of these things, because even like to Ilya's point, it's like I'm tearing up NAFTA to reinstate NAFTA, or the idiocy with the Columbia airplane where it's like, well, I'm going to put them on my airplane. No, you put them on your airplane. Where it's an argument about whose airplane it is, but it has nothing to do with deportation. And so I think that a less informed portion of the public is gratified by Donald Trump's theatrics. but I believe a huge percentage of the institutional money managers understand that Donald Trump is almost entirely theater, even if he does what he says he's going to do. When he does it, the consequence is still no change. When it's all like when the president comes out and blames the last president for a plane crash. You know, there's a level of idiocy that Donald Trump has that's apparent to anybody who can see the facts. That whether it's the Colombia pretend tariffs or whether it is the pretend NAFTA reform, he's like the ultimate, and it's like he's like pro wrestling for politics. And so there's actual tariffs that are actually consequential, actually implemented, that actually exist, and that actually do or do not redirect trade, or actually do or do not reflect a change in inflation. I think the market is basically where they would be with any president or any politician, which is these people are full of hot air as a rule, and prove me wrong. So I think the market is kind of looking past the Trump factor right now, and is more interested in second gen AI, real inflation data, labor growth, what's going on in China in terms of its domestic economy, all the things that we talk about all the time. I think that Trump has become less interesting economically because people have now made it through a few weeks of the daily theater and have massively discounted pretty much everything he says, much as they do every president.
And obviously, when he says something that actually has action behind it, as we see in the Canadian dollar today, the markets do notice, if only briefly, notice the Canadian dollar has ultimately gone not very far. It's had its time in the barrel, certainly, but if you look at sort of the larger picture, the same range that you've seen prevailing is prevailing.
Yeah, there's an asymmetry to the tariffs against Mexico and China because they're both such export-oriented economies, or at least more so than the U.S. And if you look at nonpartisan analysis from places like the Tax Foundation, you'll see that if it's an asymmetric trade war, the United States wins. If we just apply tariffs and they don't tariff us back, we win. That's it. We get more money out of this deal, net. They can't fight back, really. But if they choose to fight back, we both lose. They still lose more than we do. And that's, I think, one of the reasons you look at some of the press conferences that Canadian government officials have given recently, they kind of look defeated. They're talking about how they're still studying and figuring out how to respond to the Trump administration. Folks, we've known he's going to be president for a few months now. If you don't have a plan in place by now, you're never going to have a plan in place. So Canada here
barely have a government in place right now.
Right. And that's hugely problematic. And is the next prime minister just going to come in and try to roll over? Probably not.
I kind of hope it's not Mark Carney that they install, because I kind of want better for Mark Carney. I sort of want him to win Mark Carney is an absolutely exemplary central banker, economist, and she has an incredible record of first navigating Canada and the BOC through the 2008 crisis, and then navigating the Bank of England through the mess that was Brexit. So I kind of don't want him to just get the thing and then not win re-election, because he's probably not, whoever is the Labour leader in Canada is probably not winning this next election. The real next prime minister of Canada is almost certainly Pierre Poilievre.
Absolutely. It seems like that's almost guaranteed given the polls right now.
I kind of don't want this for Mark Carney now. I want it for him later when he's going to run a proper campaign and win.
Quickly, we missed the Visa earnings before, but they came in strong as well, which I suppose if you were looking at the PCE this morning, it wouldn't shock you. And sure enough, Visa gaps open higher today after we get the personal consumption expenditure figures. Adjusted EPS of 275 versus 266 expected. That's a gain of 14% year over year. Revenues are up 9.5 billion versus an estimated 9.35 billion, up by 10% year over year. And net revenue growth is 16% on constant currency terms. They also have, in terms of like the network here, they process $63 billion worth of transactions in the most recent quarter, if I'm reading that correctly. Just for a point of reference on a monthly basis, so we can turn that into a quarter, the Bitcoin Lightning Network is, I think, closer to $350 million worth of transactions. So we talk about, Bitcoin itself as an alternative payment system. It's really still not there yet to keep up with some of these credit card companies like your Visa, your MasterCard. Visa being a name that we floated the other day, they use AI in fraud prevention tools. You can see MasterCard here, likewise, benefiting as well as a knock-on effect. Maybe that's just and I think we've talked about this before, but like maybe this is just one of the easier trades. And certainly I keep an eye on PCE. If PCE is up, the credit card companies are going to keep going up, right? People have to put the money somewhere. So that means more transactions. If consumer expenditures are at their highest level in 2 quarters or 5 quarters now, that's ultimately a good thing. Gentlemen, when we look to the last 15 minutes of overtime for today and this week, we have not yet talked about any of our beloved commodities here, where gold is now hitting a new all-time high in the GCJ5 contract, which at 26, now to be 25 days for expiration, long the 2850, short the 2900. We are right about time to roll. And given the fact that this is a market that is in breakout mode right now, I would like to roll here. I'm going to structure this, though, in a manner that I did so when I rolled back at the end of October, which is to say that we just got up to a pretty significant high. And it wouldn't surprise me if there's a bit of give back now, backing away from that high. People have been trapped in their positions the last few months. So I'd like to get a little bit more duration on my side. My plan for this is to go out to the 84 days to expiration and structure a trade in here, maybe long the 2900, short the 2950, or just long MGC and ride it out for a little while. Either way, though, gold has a really, really strong update here. Gold and silver, by the way, have a very strong update here. Silver up 4.32% now. This is not exactly capturing the price. It's not $32.49.5 right now. We've continued to rally here after hours, so we're up at $32.75.5. Ilya, why of all days that end in Y, today was the day that the metals decided to break out?
I think probably the only thing that really looks like it rhymes with what's going on here seems to be what's going on in yields. So if you look at the situation in bond markets, you got a little bit better outcomes. You tried sort of in vain. We've given back a lot of it to get up there in ZB today, but we're starting to work through what would be this head and shoulders. And maybe that's a part of it. The dollar is a little bit higher today for the most part. But interestingly, if you look at where it isn't higher against the yen, which is the most kind of anti-yield version of what's going on. So maybe there is something developing here around yields having peaked. And that would probably make sense. I'm certainly positioned accordingly. But when you look at the sort of general layout, you don't really see the kind of explosive moves in these other assets. I mean, bonds are up a little, yen is up a little, gold is up a lot. And so maybe there is something else that's a motivator that we're not seeing as a pure kind of event risk, a pure macro kind of an impetus. Because, I mean, much as I don't subscribe to the view that Bitcoin is digital gold, if you ask enough people, you get the sense that the markets certainly view it that way. And Bitcoin is up a little today, but not a lot. So you kind of see sympathetic moves around much of the markets, but you don't see the magnitude that you see in gold. Maybe China decided to buy a big chunk today. Unclear. But I am looking to be long again. I've caught most of this recent run off the range lows. I'm just waiting for the top of the range in gold to give way to basically reestablish. I don't really love the idea of getting long silver because I'm still negative on risk sentiment, and silver has that risk on, risk off component in it. I'd much rather be long gold, but I need for this high to give way to kind of reset risk reward to structure.
Dylan, you had luck last year cornering the silver market, embodying the brother Hunt's spirits. I don't think you've been trading metals much this year so far. Do you have any interest in the space right now, or are you really just laser focused on AI?
I mean, I'm on AI, I'm on the Nasdaq at this point. It's like I think the Nasdaq has a weak posture because of its overweight on the things that we've talked about, phase one, and then the sort of stock picking on phase two. I would love to have a silver position, but I wouldn't know how to found it. You know what I'm saying? Like it's I'm sort of bounded by my own experience. So but when we went through oil and all that last year, sometimes I felt had a good handle, sometimes I didn't. I don't have a basis to have an opinion on silver, although I wish that I did. Which I don't mean to give you a disappointing answer, because I do appreciate the comparison to the Hunt brothers, but I hate to say things, especially in public, that are baseless. And so, I look at that silver chart and I haven't the slightest idea why silver or gold had such a fabulous surge here. I'm mildly envious, as always, when something goes nuts that I'm nowhere near, although not at this point in my life, it doesn't really bother me so much. I'm happy with the things that I do have a handle on and that work. And, I'm open-minded. This is one of those ones where I learn from both of you in terms of your technical points of view. Like, is this one of those ones where because it's now moving higher, it's going to keep going higher? Does this make you more bullish that this hasn't happened?
I mean, I'm looking at the technical setup here, and it's, we've been talking about this for a few days, how it kind of feels like these are mirror images of one another, where you have this consolidation and then breakout, consolidation into a wedge and then breakout. I'd point here in MACD, for example, the rhyme and rhythm, that once you break the downtrend and you get that push higher into the upper half of the indicator range, that's a change in behavior when previously we're kind of setting the lower lows, lower highs in the indicator. That breaks that trend. That's starting to play out here again now, right? We poke up into that territory. We get that early sell signal that, quite frankly, is a red herring. We get another one of those a few days ago. We're now back to long in the indicator, and we're starting to poke up into that upper half of the signal range. So the way momentum is shaping up here, it feels like it has something that it hasn't had as it's been trying to gather its footing. Previous attempts to reestablish or reassert momentum have been quickly shot down. So do we, is this going to be like December 12th again, the last time we had some legitimate acceleration here to the upside? I certainly hope not. Those SIK5, the 33 and a half call spread that was put on last week is now finally working again after sucking wind initially for the first 4 or 5 days it was put on. And I'm with, the first at least strike having been reached today, I'm totally comfortable holding on to this now. The only question is, again, is it worth extending and buying more time? I think the answer is yes in gold, and silver no, only because silver still has so much time on the board. But the commodity space generally, right, as we talk about a potential US dollar top here, I mean, we can't dismiss the fact that commodities are holding in here. Even DJP, the commodity total index return ETF, when it had its pullback off the yearly highs, it just went into that 1 month moving average and started to bounce again. So we're not exactly, showing that we're ready to give up all the gains that we've seen. Oil price is very much pinned near the key level of 72 here, Elia, but it's a 4.3 IVR. What a tasty trade.
I'm holding short, and I got all kinds of duration left. I specifically bought it 60 days out. I still have 50 days left. So I'm just going to sit here and let this correction continue. At this point, it's not doing anything to suggest that it won't. It's begrudgingly making lower lows. So, okay. It's one of the slow, quiet winners in my portfolio right now that's helping to paper over stocks not finding direction.
I mean, my only thing is if I'm bullish on economic activity, which I am, and I'm also, I think inflation is more likely to increase than to decrease. I'm more inclined to be long all of the commodities, including oil. So as oil gets lower, I get more interested in owning it. I haven't taken any action on it yet, but I think the economy is relatively strong. I think second-gen AI only supports that. And I think Trump is a maniac, and ultimately it will result in inflation, all of which I think results in higher oil.
You seem particularly perturbed by Trump's press conference today.
I just want to see leadership that speaks in some form of reality-based reality. And it's sort of I sort of laid back for the first month to let it, just to watch, see what happens. And I saw the executive order struck me as, sorry?
It hasn't been a month. It's only been like a week.
Whatever.
He's only been in office for a week, man.
I gave him a week. That's it.
So what I mean, it feels longer than that. It's a lot
of theater, right? Bro. And it's like this plane crash is the next level. It's one thing to like talk about the economy or talk about policy or whatever. It's another thing if you have a T-bone of an American Airlines airplane on landing at Reagan National, and you make it a point of political scoring opportunity rather than a national tragedy, which is obviously what it is. So forgive me, but it mildly irritates me because I would just like to see America is such an amazing country and is such amazing people. And Biden was a non-existent leader or grossly incompetent leader. Trump in his first term was catastrophic as a leader in terms of his presence. And now we got this yeehaw back. It's like not that hard. The one line I liked from the RFK confirmation was, there are no Republican children, there are no Democratic children, there are just children. There are no Republican airline passengers, there are no Democratic airline passengers. There's just people trying to get home on an airplane. And there's room in the world and in America for political leadership that can make space for that. And that makes me sad today that that's not what's happening. So.
No, that's not what happened at the press conference. The press conference was very clear. Trump spoke. Sean Duffy, the new head of transportation, spoke, Department of Transportation. You heard from J.D. Vance, and they all lauded Trump for his extreme leadership during this trying time. And then Trump came out and blamed the FAA and their hiring practices. And Buttigieg and Obama got a shout out in there too. I think I heard something about dwarfism as well during the press conference. So it was really all over the place. And I'm not sure if it really solved anything. It seems like this is a total one-off freak accident based on everything I've read, Dylan. So I'm not sure if this is,
I just look at, who knows? I don't know. I look at that and I see a failure in air traffic control, which I look at as a matter of understaffing. Maybe it's a matter of competence. But to say that it's a competence issue at this point seems absurd. It is. To say that it may be an air traffic control issue seems reasonable. I don't know whether it was confirmed, but there's a report that it was understaffed. That normally there's one person who runs the helicopters and another person runs the airplanes, or multiple people, I'm sure, run airplanes, and they have the same one individual managing helicopters and airplanes. Anyway, I have obviously no idea what happened, but the correct leadership decision is to say, this is terrible. We are going to do everything in our power to understand what happened. We're going to do that diligently, thoroughly, and rapidly. And we will then take actions to remedy anything that becomes apparent from those investigations. It's not a complex statement that needs to be made at a moment like this.
Yeah, you mentioned the reporting here. It looks like only one person was working a job for two people. So this is, understaffing in the among air traffic controllers, and it's a tough job. I don't like flying, generally speaking, so I can't imagine having a job where it's to land planes all day, and we feel bad for all the families, everyone involved, the military craft, to the soldiers that were killed. It's just a terrible set of circumstances. I only bring it up here a little bit at the end because I did see I see the conversation on Twitter. How come there's not a bigger reaction in the stock price? Look, sometimes if it's an idiosyncratic thing and it's not indicative of some systemic issue, it's not going to lead to a collapse in a share price. More importantly, this is the first major commercial aviation disaster on U.S. soil in 15 years. We have incredibly safe skies. Right, it is it's safer to fly than it is to drive to the airport for your flight, as the statistics show. So, is this indicative of any long-term problems? Hopefully not. Probably not. There's been a lot of near misses at airports. The FAA has had to convene emergency meetings at 90 different airports around the country to remind air traffic controllers for what to do and not to do. So, hopefully, this is another tragedy that is simply a one-off and does not extend any further. Gentlemen, so I suppose on that more somber note, we'll head out the door here for this overtime episode for this week. We'll be back on Monday, same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak and Dylan Radigan, I've been Chris Vecchio. After a brief break, though, Tasty Live programming does continue here at night. We'll be back with Ilya Spivak and Macro Money up next.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Every day I do God's work here.
From the smart mouths at Tasty Live.
Twitter versus Facebook. A rap battle. First up, Facebook.
Twitter
snuff you out like I did to my space. I'ma have to erase your little Twitter face. Warm it up, Facebook, I'm about to. Did they make an Oscar-nominated movie about you? Check my school out, I'm at the top of my class. My main interest is listed as kicking your ass. I help dictators get thrown over. You help the cast of Jersey Shore get overexposure, I'm too Titanic for you Twitter retweets. You bird-ass tweets, stick to the branches. I'm root deep, universal expansive. Twitter better get lost before you get poked. What? What?
Yeah, this is Twitter. Check it. At Facebook, can I attack you? Yes, and I could do it in 140 characters or less. Brevity's the soul of wit. I'll make this quick. Hash mark. Facebook is a dick. Retweet. Yeah, I'm backing that ass, and I'm young and I'm brash, and I'm packing that cash. Stick with the kid, I'm an early adapter. Your old Facebook played out like Napster. I make it real easy for family to talk. I make ex-girlfriends real easy to stalk. I show you life in real time that's completely amazing. I show you which celebrities are totally crazy. From Blitzer to Sheen to Kanye to Rom. I run with stars, Facebook is a place for your mom. What's the matter, Zuckerberg? Don't like how that sounds? I got 1 million customizable backgrounds. You're so totally boring. My card's on the table, hash mark. Facebook is disabled.
We just ripped higher up to 50 points, and I just thought we would stay there, but...
The thing the market does best is it keeps you very humble.
You get paid a lot for being right, and you lose a lot for being wrong.
So give me, I don't know, a couple hours, and I will give you everything that you need to start trading options. See you inside.
Got the need for speed? No problem. At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
Another big batch of macro risk is out of the way, and the markets still don't care. GDP numbers out today following the Fed meeting yesterday, and still the waters do not stir. We get one little bit of macro risk left for the week, and then we'll see what the markets end up doing when that's out of the way. And of course, that is what we are going to focus on here today. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. What we are going to try to figure out here is what that market default is, because as we look at what the markets have been doing so far this week, their resilience has been really remarkable in the face of what is a very busy week of event risk. And what they reveal is seemingly an unwillingness to make any sort of a concerted effort at conviction as those outcomes have appeared. So what we're going to do here is go through and, first of all, take a look at the substance of these releases and see why it is that the markets concluded that they don't change the landscape, and then see what happens once that kind of event risk really and truly steps out of the way and traders are left to their own devices. So here's the outlook for Fed monetary policy this year and next. Note that over the course of this week, we've gotten a little bit more dovish, just a touch. But what that's ultimately done is just brought us back to where we started when the Fed delivered its latest rate change back in December. we're essentially sitting squarely in line with expectations, at least for this year. So 46 basis points on the board for 2025. The Fed's official forecast is 50. Essentially, both of these are calling for 2 cuts this year. The real question then is what happens next year. But the more important issue is that there's been a bit of an attempt to push higher. That's where the markets got all kinds of concern from mid-December that things were getting a little overheated. But then we come back and we're basically back to baseline. You can really see it when you look at the implied path for rates in Fed funds futures. Here is that very dovish view in September. Of course, since then, the markets have been on a mission to reprice for something more hawkish as the economy has shown itself to be stronger than expected. And of course, once we got the election outcome and it looked like that inflation was going to get a tailwind coming out of it, be it from deregulation and tax cuts that people were benchmarking against, or tariffs and some sort of a immigration crackdown that disrupts labor markets. All of those things comport to more inflation at face value. So we saw a repricing of expectations that already was mostly there by the beginning of November. And what we find is that the current curve, a day after the Fed's policy announcement on today's session, is barely moved from where it was in December, and indeed is clustering where that November adjustment was. So we're really not seeing a whole lot of revision here after this week's events. What were those events? Well, first, there was the Fed policy announcement. Here's the text, and thank you, Wall Street Journal and Nick Timmeros. We can see here what the changes in language were. We see that it is remarkable in its milquetoast character. It is as neutral could possibly be. The unemployment rate has stabilized and the labor market remains solid. Okay. Inflation remains somewhat elevated. Okay. In other words, not much is going on. What we find also is that in the press conference, when we have a discussion about the erasing of this text, and Powell is asked point blank whether the committee no longer believes that it's making progress toward its 2% objective, and that's why they took away that text, Powell very clearly said, actually, no, this is just new year, new statement, some wordsmithing, but that's really it. This is not a signal. And so, not surprisingly, there's not a whole lot here that moves the needle. At the press conference following the announcement, in fact, the most profound thing that Powell seemed to say was that the committee is broadly not favoring any sort of rapid move and don't think themselves as needing to change anything in any sort of a urgent way. They don't feel that they're in a hurry. And then also mentioned that he feels most of the rise in longer-term interest rates recently has been about term premium, that is to say, uncertainty about the future path of rates and the pricing in of that uncertainty as higher yields to be compensated for that uncertainty risk, than anything to do with policy. It's an interesting perspective and perhaps reflects the rise in term premium as indeed it has around the situation, of course, with rates and the reheating of the economy, as well as the new administration's policies. And to some extent, perhaps this adjustment in baseline is indeed term premium related. But nevertheless, expectations don't move much as a consequence. It is certainly the case that if we take a look at the current 10-year yield and take out the term premium and take out the break-even inflation rate, we end up at just 1.4%, which is the lowest since September, of course, telling enough, this adjustment happens from September. And then if we take a look at the 10-year yield by itself, it's 4.5%. So needless to say, a huge component of this is inflation expectations and indeed uncertainty. We then go and see the GDP numbers. They end up being a little bit lighter than expected, 2.3% versus 2.6% expected on the annualized growth rate. And the internals here seem to be particularly interesting. This was actually the fastest month for annualized consumption growth since back here in January of 2023, the first quarter of 2023, and needless to say, that has been a major uplift here. If we consider sort of the share of each of these components in overall GDP, the latest numbers have consumption at 68.2%. So needless to say, that's really the big deal here. It is still noteworthy, though, that for the first time, interestingly again, since the first quarter of 2023, that investment records a fall, and not a trivial one, in excess of 5%. Now, most of this you could probably chalk up to the drawing down of inventories, but if those inventories are being drawn down, well, then one thing to conclude might be that there will be more production downwind to rebuild them, and another might be that production has been slowed because there is an expectation that demand will be weaker downwind, and that's why inventories have fallen by so much. So we'll see, of course, how this develops, but the market does not find it to be uniformly negative, clearly. And so, again, Fed policy expectations are left unchanged. If we take a look at the contributions here, then we can easily see that consumption, with its rise, though in percentage terms, we can see this was a smaller rise than the fall in investment. Consumption, because of its outsized share, contributed much more to the upside in GDP than investment shaved off, though, again, this was the first such negative contribution for quite some time. This leaves us with but one piece of economic data left on the calendar, and that is the Fed's favored personal consumption expenditure measure of inflation. The expectation here is that we are going to rise on the headline to 2.6%, and that the core will remain at 2.8%, that's year on year, for the third consecutive month. Now, for the headline, this would actually be a significant increase. 2.4 was the previous number, and 2.6 would be the highest since May of 2024. So this is a meaningful increase in the headline. But as we can see, much of the rise recently has been less so about inflation going up and more so about the negative influence of energy prices in the calculation, rebasing out of it. So you can see in the yellow bars here, this is the negative contribution from energy into the overall PCE winding down. And against that backdrop is where you get the headline inflation number rising, but core is much more contained. And it's because, of course, it excludes energy and excludes food in the calculation. Now, it is certainly the case that 2.8% for a third consecutive month is itself an elevated reading. The last comparable number, and frankly, the last time that inflation was higher was back in April of 2024. That was 2.9%. And when we look at the internals of how this is trending, you end up with somewhat of a mixed picture, but certainly not one that suggests, at least at face value, that the Fed ought to be in a hurry to cut rates again. So at the top here, we have the core PCE in annualized terms. In the blue bars, it's the 3-month rate. In the red, it's the 6-month rate. And then on the bottom is the actual data that we see reported. This right here is a core year on year, and the bars are month on month. Now, it is certainly the case that in November, month on month, the increase in core inflation was relatively modest. And by the way, the reason that we're looking at the core, of course, is because stripping out energy and food here makes sense. We can clearly see most of the inflation sits in core services. Core goods is barely on the menu here, and housing has been steady and looks unlikely to do much of anything until mortgage rates come down in earnest. And of course, that has to do with what the Fed does next. So the real question here really is, what will the Fed do about this right here? And that will have knock-on effects for housing. So how is this key variable moving? Well, again, the month-on-month in November certainly seems to have been an important downtick. But if we look at the trends that implies, what we find is that, helpfully at least, the 3-month annualized rate seemed to come in a bit in November relative to October. It had been rising, but the 6-month rate is holding steady at best. It is certainly not starting to recede. And what that suggests is that the medium-term kind of dynamics when the Fed considers the incremental case for a cut are probably not there. The trend, as it were, is not being reestablished in earnest toward more disinflation. Now, generally speaking, the market is pretty good at benchmarking these numbers because typically the CPI and the PPI numbers out of the BLS come out before this. And in them are components out of which you can construct a very close estimate of PCE. And so the markets generally don't get the forecasting terribly wrong on this. It's very rare to have a complete left field surprise on PCE. And so the numbers are probably going to come in somewhere in line with these expectations. Moreover, if we look at the way U.S. economic data has performed more generally relative to forecasts, this is an index from Citigroup here, where 0 is no surprise, above 0 is positive surprise, below 0 is negative surprise. And of course, as these things accumulate and as they move markets, you get distance. So more potent upside surprises, less potent downside surprises as the index moves. And so what you find here is that there's been a kind of reconvergence towards 0 since basically the beginning of the year, where U.S. economic data seems to be tending toward expectations, where essentially analysts' models spitting out economic forecasts seem to be, broadly speaking, well-tuned for economic reality as it then presents itself. So we end up in a situation where not only is the PCE number generally unlikely to surprise, but U.S. economic data at its current setting is generally unlikely to surprise, at least not by a significant margin. And so, once again, the bottom line seems to be that this is where we're left. Fed policy expectations anchored. The path forward basically unchanged after a week's worth of high-flying event risk with all kinds of opportunity for fireworks, but ultimately no fireworks realized. What does that mean going forward? Well, consider how the week began. We started right here with a violent gap lower, a loss of, at one point, as much as 3% for the S&P, and a generally negative day across all but the Dow Jones as far as major U.S. equity benchmarks, all that around the idea that China's DeepSeek released an AI model that looked like it could rival some U.S. offerings at much lower cost. Now, there's, of course, been a sea of ink spilled on this already, but I think the markets had the verdict from the get-go. And that, of course, was that this is not a displacing of U.S. supremacy in the space by China, or else Chinese markets would rally up a storm, and they didn't. And, of course, now we're getting all of the commentary suggesting why, on technical grounds, on spending grounds, it's not exactly apples to apples, and this is not a shift in leadership, et cetera, et cetera. All of that being said, there is still another ocean of ink to spill about what all of this will ultimately mean. This is not something that's going to get decided today or tomorrow or the day after. However, what we certainly see and what we certainly know at this point is that the markets didn't like the announcement. They've gapped lower. They have not recovered. They have been idling since. And perhaps the markets didn't like it because what this announcement did was cast doubt on the trajectory that was already baked in for the AI future in all sorts of benchmark assets, be they NVIDIA or any of the other usual suspects in the AI stock universe. If your expectations were that this much money is going to get spent over this much time to build this much capacity, well, now you're not so sure about those expectations. And perhaps that's why the gut reaction from the markets here was divestment. The most curious bit for sentiment is that we have not seen relief. And perhaps the reason we've not is because we've had this macro event risk every single day this week since the DeepSeek news came out. And it's not surprising that in the midst of a large market move, when you are essentially presented with all of the top tier macro event risk you could possibly imagine. You have a Fed meeting, an ECB meeting, US and Eurozone GDP data, a Bank of Canada meeting, CPI data from Australia, just over and over and over, more and more macro risk. And none of it ultimately moves the needle. But all of it is a potential to do so. And of course, what we now then see is that Fed policy expectations are stable and they're unlikely to be dislodged. So the one thing we've learned from this week is that the markets are not going to find some sort of soothing salve from monetary policy after their tough Monday. And the markets are showing that because we've gone absolutely nowhere. And to the extent that the same sort of upshot comes out of the PCE data, one has to wonder if the default then isn't, well, we paused for macro risk. We did not want to have conviction while it was coming out. Nothing helpful came out of it. Nothing hurtful came out of it. We return to where sentiment was ex ante, before the macro risk started to spill across the wires. And that, of course, brings us back to the very same uncertainty about what DeepSeek means for the AI build-out path, and not much else. And so perhaps what this PCE report might in fact do is be more potent in its passing than its substance. Because once that event risk is out of the way, the markets are then left to whatever default they choose. And their lack of conviction over recent days perhaps gives way, of course, in the absence of any meaningful difference in the story from the macro side, where it looks like stasis in Fed policy bets is undefeated. We just come back to where the story was before. And that makes for a rocky end to this volatile and ultimately more confusing than anything kind of week. That is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. Back with Chris for Futures Power Hour, Mondays and Fridays. That's where I'll be tomorrow. I'm on with Victor Jones for The Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter, as well as now on Blue Sky as well. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
What is going on, everybody, and welcome back to the Bad Taste segment. We're back with Luis. We got a lot to catch up on. DeepSeek, NVIDIA, some bad trivia. Your hair's getting longer. You had another kid. I don't know. What's new with you, bro? It's good. It's good to see you as always. How are you doing?
Man, you were the man that had another kid. Now we have 4 or 5. I forgot.
Yeah, right. Yeah, right. You're older than me, amigo. But
just like a month.
No, I know. It's good to be back with you. I know we got a lot to catch up on. The market's been really volatile. What's going on, chat? What's going on, anybody watching on YouTube right now? I know things have been volatile. A lot of, the race to AI, a lot of that thing's a new administration. So there's just a lot in the air, a lot for the market to digest, a lot for me and all of us to talk about, digest. But what's top of mind and how we doing? How we doing today, Luis?
Excited to be here with you, E. Yeah, a lot to talk to about, but seems like even though with DeepSeek yesterday's drop in the market, the Nasdaq, there were 23 stocks today that actually hit an all-time high, and there were big names: Meta, GoDaddy, Amazon as well. I don't know if you saw Reddit today. Reddit pumping after hours as well, hitting 200 per share. Oh my God, we Reddit, JP Morgan, Spotify, Cardinal Health. Those are some more of the names that actually hit an all-time high. MasterCard, Visa. But I don't know about you. I was able to have a good day yesterday a little bit because I went short on Friday. You know me. I always do a little bit more short. But I've been playing more on the quantum stocks. I'm actually curious to see if Julia still has her IONQ position. But those stocks actually have had an amazing price action, especially IONQ. That's the one from the quantum computer stocks that I think has better price action. But overall, focusing on IONQ, a little bit of DAT. I think now that Trump is already elected, inauguration is already over, the hype has died a little bit, so I'm playing it to the downside on DAT. More of a DN trades on that side, you know me. But how about you? How was your day today?
No,
Did you went long in NVIDIA yesterday?
No. I wish I would have gotten long NVIDIA yesterday. I know it's having a pretty nice recovery, and we're going to talk a little bit about that when we get into these slides here. But NVIDIA is bouncing back a little bit. I mean, it's come from a low of, what was it, 119, 116? And I mean, we're up over 10 points into the close. So I don't know. Was it an overreaction? Was it a valid reaction? What are we thinking here?
I don't know. I honestly think maybe it was a little bit of a reaction, but I don't know if you saw Alibaba today. The new king of AI, it's actually not DeepSeek, it's Alibaba. Alibaba today announced their new AI and actually outperformed ChatGPT and DeepSeek. Look at it. Do you think it's going to hit 100? I actually went long Baba today. Few of the stocks I'm actually long. I'm long JD, Baidu, and Baba. I actually entered Baba today.
So is this just a bubble, Luis? Is this just a part of the hype? Is this just part of the... I mean, Baba, so we have earnings soon. Was it on Baba or was it NVIDIA? Yeah, so we have earnings soon on Baba. I'm curious if in the reports that they're going to be mentioning anything of AI and what they're going to do to satisfy a lot of the shareholders. But I haven't been taking part in any of the specific underlines like Baba and things like that. I've been keeping a close eye on the volatility index. I would have thought a move like yesterday would have sustained a little bit more of fear within the market. But I mean, such a massive recovery. I mean, thanks to, some of the underlyings like NVIDIA, we had a massive recovery today. And then like you mentioned before we even hopped in here, what was it? 23 underlyings set a new all-time high today?
23, yes. And big names actually hitting all-time high. I honestly, I like Alibaba, and I do not think for the Chinese stocks there on the bubble. I think there's actually a lot of opportunity. But look at Meta. Meta recovered 70 points from the lows yesterday on the pre-market. It traded at 606. Today reached 680. They're going to be reporting tomorrow.
Yeah.
I don't know what are your thoughts for Meta. Starbucks also reported today, but CrowdStrike hit an all-time high today. Seems like they forgot 100% from the outage on July 19.
What was the ticker for CrowdStrike?
CRWD.
Oh, CrowdStrike, got you.
Yes, look at that. Look at that huge candle today. Massive movement. Honestly, I always liked this stock. I thought it was a very cheap stock when everything happened, but at these levels, getting the all-time high, maybe for a pullback. I don't know what you're thinking. I think there's a lot of opportunity. There were some price targets increases today from prior to earnings. I don't really like that when banks actually get ahead from their earnings, but that actually caused the big hike today.
I'll be a little bit cautious with something like CrowdStrike, just because when I look at the duration, I know we have earnings soon, March 4th. So that's kind of what comes top of mind with CrowdStrike. I don't know, maybe you could even do some type of vol expansion strategy, something along those lines. But for that, I'll most likely be on the sidelines. And I know you brought up Meta too. But CrowdStrike is one you've been bringing up a while ago. I remember you were putting on CrowdStrike one time. I think it might have been even over a year ago. And then I started trading CrowdStrike a little bit more too. But I know Lone is talking about how he's despising Meta right now. And I mean, I don't know how I feel about Meta, especially with earnings after the bell tomorrow. I mean, such a strong move the last couple of days into the all-time high. And then we have something like earnings. So is it going to be something you're going to feel more comfortable with fading the move on the earnings, just focusing on volatility or whatever it might be? But that's most likely something I'll stay out of, but it's very tempting to take part of. If some of these didn't have earnings, I probably would have been looking to sell some out of the money call spreads because the IV is really solid. Could probably sell something around the expected move. But because of earnings, that's probably not going to be an option for me. But just to see what some of these are going for 230. I mean, that's a little cheap for a $10 wide. Even if we can go $5 wide at $1.40, that's still a little premium's even all right in here. But I mean, it's got earnings after the bell tomorrow. So who uses Facebook? Why is it Meta $0? Last I heard, they were creating their own bots to create more engagement. Maybe the Meta bots are talking to the Russian bots and the advertisers are too dumb. I don't know what's going on with Facebook. Do you use? I know you use Facebook.
I use Facebook. It's the best social network out there.
Why do you? What is Facebook? What tools does Facebook have that you enjoy and as a user get a lot of satisfaction out of?
The only part I get a satisfaction from Facebook is actually the video part. I don't know why I like it so much.
The video part? What do you mean by that?
I don't know. There's a video section on Facebook where a bunch of videos pop like based on your algorithm.
So is it like a reel, like Reels almost?
Like a YouTube, because there's like a long format of videos and also like Reels as well. But yes, I've heard a lot of stuff that nobody uses Facebook anymore. But when you take into the fact that it has more than 2.2 billion monthly active users, it's a bunch of numbers.
I mean, it is worldwide, right?
Yes.
I mean, it is one of those things where I think certain tools, softwares, whatever you want to call it, is more prominent and more common in America. Like, for example, WhatsApp. WhatsApp is a massive app, but I wouldn't say US isn't the predominant user base of something like WhatsApp, is it?
I think US no. Actually, I think other countries.
Just to show culturally, certain softwares are a little bit more popular depending on where you're at.
Here in Mexico, we use a lot of WhatsApp, but I've seen that in the US they use a lot of, especially the ones who have iPhone. What is it called? Chat or iMessage? iMessage.
Yeah, iMessage. Government Mike saying 2.2 billion bots, Luis.
2.2 billion. Maybe it's going to be the next 2 billion market cap company. It's actually trading at 1.7 billion market cap. I wouldn't be surprised with Meta actually reaches that. It's had an amazing run since November of 2022 when it was trading at $88 per share, now almost at 700. Last quarter they actually gave a weaker guidance. So if their guidance still is weak because they actually recovered quite nicely from their past earnings, I'm definitely going to be fading this stock. I think I'm not going to say it's expensive because they have a lot of market potential, especially that they own Instagram, WhatsApp, Facebook, all of that. But since they've missed earning guidance last quarter, right now they actually miss it, especially on their daily active users. Meta used to hold the throne for the biggest loss on market cap on a single day. They lost like 250 billion. Now, well, Nvidia has actually overtaken it. Yesterday, Nvidia lost $589 billion in market cap. Crazy number. But Meta, that's the day they actually missed on guidance and also on daily active users. So I don't know if they might actually follow Netflix because Netflix stopped reporting their user subscription for their next quarters. But if they were to miss it, which it's strange to see, like every single quarter they are actually beating their daily active users, monthly active users for Meta. But yeah, I'm definitely interested on fading Meta if they were to fail. If not, maybe for I'll actually sell a vertical spread on Meta, but for a longer term.
No, yeah, I'll be taking a look at it, especially post earnings. If there's a little bit of juice left in some of the contracts and volatility is decent, I'll take part because again, we're at the all-time highs and have a little bit more clarity after earnings.
And Reddit, have you seen Reddit?
No, I haven't. RDDT.
No? RDDT. Oh my God! Today I've tried to find the news what happened or why it's actually pumping so much. After hours trading at $200 per share, I saw a price target increase saying that what 197.
Who was that from? What price target was that from?
Check it. Who it was from? It was from. Let me see. Piper Sandler actually gave a price target of 197 today after the market closed. That's why it's pumping a little bit. Seems like they're actually bullish on Reddit because it seems like AI companies are actually taking information from Reddit. I think ChatGPT actually searched a lot of or trained their models using Wall Street Journal articles and also Reddit.
No, I mean, it's having a massive move. Volatility is decent. Earnings coming up on Reddit. So that'll be another one that people will be looking out for after the bell February 12th.
Below 200, if tomorrow we see some weakness, I'm definitely going to see if I can actually fade it to the downside. It has less than a year in the market since its IPO.
Yeah, the IPO was when? It wasn't that long ago.
It was March, I think, of last year, April.
Yeah, so not even a full 12 months.
Nope.
Other than that, I mean, been looking at some of oil as well. Oil is another one I want to take a little bit more part of. I was trading some of the futures. I was trading some of the options on the futures over the last couple of weeks. Took those off fairly soon, but still kind of getting my feet wet because the risk is a little bit different. They are strangles that I was selling to, so they're undefined risks. So I've just been mindful about that. But I've been taking a little bit of a look at some of the oil futures as well. In Meta's defense, I have an account I set up to sell crap on the marketplace. Profile says I don't want friends, but he keeps suggesting people. Yeah, that's fair as well. I mean, I think I might have 3 or 4 accounts over my time of accounts I've opened with Facebook. So my mom had sent me a Facebook meme the other day. I think it was less than 48 hours ago, and I tried to open it up, and it was wanting me to sign into my Facebook, and I don't even know my login. And I just messaged her back, letting her know, Mom, I don't even have the login for my page. I can't see just screen record the meme and just send it to me. But anyways, anything else top of mind before we head into these slides for today, Luis?
Well, you're missing on the best social platform right now, currently.
I don't know. I used to think Facebook was my personal favorite platform when I was 12. When I was in 6th grade, I remember I texted my dad. I was like, well, I made the account first, and then I texted my dad. I was like, is it okay? It's like, can I make a Facebook? Because I was like, he's gonna find out I have one anyways. Let me just ask. So I did ask, but I did make it a little bit prior to me asking, and he was fine with it. And I mean, it gave me it was like a huge sense of community. It was like all of my friends were on there. We're in middle school. We're just getting to the age. I remember I saved up for an iPod Touch at this time, so I had a device where I can get onto the internet. And it's like at this time, you're forming community and doing this and that, and then just communicating with your peers outside of school hours was just something so different and convenient and kind of cool to do. So I remember that's why I originally loved Facebook and loved the idea of a social network, being about in like that middle school time frame. But after high school, I would say after maybe 10th grade, it just wasn't very relevant in my life. I don't know if it's because I'm not using it. Like, is Facebook mainly because people are connecting with friends and family? And if that's the case, I mean, I don't know. There's a lot of use. I just wonder why, I don't use it as much anymore. I don't have as much of a need for it.
I think having uploaded a picture to my Facebook like at least 2 years, added a friend over the past year, had to use it only to watch like some videos and memes. Honestly, I think it's definitely fading, but I still like it a lot. But let's see what happens tomorrow with Meta. Definitely exciting to see. If they were to miss any number, which I think for the past 2 years they have not missed it. The last time they did it was in 2022, around April. So that's when the stock actually tanked 25%. So with that given, I'm going to be watching with popcorn. Starbucks report today, they reported it was kind of mixed, the report. Stock's actually up $2, but yeah, it's going to be a heavy week with Tesla as well. Tesla, I still say, and you've hear me say this a lot before, that I think it's a very expensive stock, especially given the fact that an auto manufacturing company worth around 1.3 trillion. It's more than combined all of the top 15 auto manufacturing companies in the world. So sales have actually been decreasing on Tesla. Competition starting to actually ramp up among others. So yeah, Tesla, I'm also looking at for the short term, although I'll wait until, for the short side until the report. But excited for some trivia.
Yeah, let's do it. I know we got a few fun facts. I'm excited for Tesla, by the way. I mean, I think Tesla is always one of those ones that I think everybody's excited for, even if you're not actively trading it. But as we get into this today, we do have an app. You can come check us out. We do have more footage running on throughout the days, and there's a lot of points that you can get. And typically when Julie's here, we give some points throughout the chat whenever we get some of these trivia questions correct. So look out for that, but it's always a good time. So definitely come check us out. DeepSeek, Luis, I know we kind of touched on it before we get into this trivia. DeepSeek, we wake up Monday morning, market has it almost, what was it? It was like 800, a lot of points down over just the weekend. And I wake up just thinking, again, I refreshed my platform because we had a massive gap down. I thought a lot of the data wasn't loading. But apparently we had a lot of news with DeepSeek, and we already know how much of an impact ChatGPT has already had on just technology and how we utilize things today. So DeepSeek really came out of nowhere. I know innovation is a good thing, but the DeepSeek's breakthrough is a Chinese AI company, and they developed an advanced AI technology just rivaling ChatGPT for just $6 million. So a lot cheaper than ChatGPT is doing it at. And as anybody understands business in general, you're going to do things for a lower cost if you're able to, especially if you get the same type of quality or value, whatever it is. And then the market impact, shares of AI leaders like NVIDIA, ASML fell as DeepSeek's low-cost model raises concerns over demand for AI chips. I saw a lot of conversation that this was a lot of hesitancy from investors and the industry as a whole, trying to understand where they should be parking a lot of their money or investing a lot of their money. Do you think that's kind of what had the massive impact on the market and just the overall sentiment, investors' uncertainty, I guess you could put it?
Yeah, for sure. I think given the fact that, OpenAI raised a capital round for around 20 billion, given the value for the company, 150 billion. So when they see that, so maybe OpenAI is actually screwing investors and AI is not as expensive as one might actually thought. So with that, I don't know, even Trump actually praised DeepSeek, saying that it's good for the competition. And although he actually even said that it might actually not even be true, because I don't know if you saw, there was a guy, I forgot his name, on CNBC yesterday that came out and said that DeepSeek has 50,000 H100 GPUs from NVIDIA. The cost of each single GPU from NVIDIA H100 is around $40,000. So if that were to be true, it's not $6 million. So they might actually be lying. Who knows? It's not certain. But I think, that was the main fact that, if somebody's doing the same stuff as OpenAI, ChatGPT, for a way lower price, maybe the valuation from all of these companies, NVIDIA, Meta, not Meta, but NVIDIA, AMD, all those, it's actually not sustainable for now. So I don't know. Let's see if that's actually true or not. But today, Baba came in with an even better AI model than DeepSeek.
Yeah, and I know we had that massive, pullback on NVIDIA we just had checked out, post news. I also wonder, is this also just a normal correction within this sector that was needed already? Like, could you also make an argument for that?
Yes, I think SMH. I've been watching Tim Knight, and he was saying about a possible correction for SMH, especially the ETF, and we got it. I think that's healthy. Normally, since 1950, there's a correction once every year between 5 to 10%. Last year, we did not got one. But I think the biggest drop for the S&P 500 from the top to the lows was around 9%. So, I think it was not even 10%. So that's healthy. We got a nice recovery, 20%. I don't know. will you be buying here NVIDIA? I wouldn't be buying NVIDIA me personally here, but I think it's definitely healthy. That's what the market needs. But it erased all the gains since October 10th. So big drop.
That is a big drop. Bad trivia on the day, Luis. We have 2 on the day. Remember, guys, close your Google browsers. No cheating. But we do have the chat as a resource. So we'll see how we do on the day. Which company's IPO was famously delayed in 2012 due to technical issues on the NASDAQ? You know what this kind of reminds me of? I don't know if you know, but Nikola Jokic, right? He's the MVP of the league. Arguably, in my opinion, still one of the best basketball players playing at the highest level right now in the NBA. Plays for the Nuggets. I'm from Colorado, a little biased. But anyways, whenever he was drafted, there was a Taco Bell commercial that had played, across the screen as he was being drafted. Little do you know, this guy's going to go win a championship ring and be one of the most skilled basketball players at the moment. But this is what it kind of reminds me of. But because, each 4 of these companies, panned out to be very successful companies. Obviously in hindsight, companies like Netflix, definitely pivoted a lot. But which one of these companies do you think it is? It is, Luis. They all ended up, regardless of their technical issues with the IPO, all of that, they all became very successful companies. But we have Facebook, Twitter, Amazon, and Netflix. What do you think, Luis? Chat. What do we think?
I think the most. I'm between Facebook or Twitter. I think Amazon definitely was IPO around before 2000. Netflix,
okay,
guessing around 2008, maybe something like that, closer. Facebook, I know it was around 2012 or 2014.
Okay.
But and you know what?
What were you?
I'm gonna go with
you were taking out your first mortgage when this happened, or what were you doing?
Your grandkid was born around this age,
right.
This year.
Right. You remember this like it was yesterday. My man put down his newspaper and his coffee and watched Facebook IPO or Twitter IPO.
And no, you know what? Definitely I'm gonna go with Facebook. I don't know why I think it was actually its IPO around that year. But I'm between Facebook and Twitter. Let's see here.
I mean, we got Twitter and Facebook in the chat. It's a 50-50 split at the moment.
Twitter, chat agrees with me. Facebook.
All right, I do see it. Twitter. Are you sure? Do you want to confirm and send? I'll give you 3 extra seconds.
Confirm and send. Also, go Philly. I don't know if you watched the game. Who you got for the Super Bowl?
Oh, bro. What do you mean? I'm a Broncos fan. Everybody's a fan of the Eagles right now.
Yep.
Are you one for Philly?
Yes.
Okay. Shout out Jalen Hurts. And shout out Saquon Barkley. First mortgage 1993. No, in 2012, I think Luis is taking out his first mortgage. Luis, if you guys don't know, he's about 45, somewhere around there. But no, it is Facebook. Facebook's 2012 IPO was marred by technical glitches on the NASDAQ, delaying trades and leaving many investors unsure. Kind of scary whether their orders were executed. It's probably one of the scariest things, not knowing whether or not your order just was executed or not. But classic example how even some of the most anticipated IPOs can have some technical issues at the jump. So we got that one right, 1 for 2 on the evening. Last one, what unusual item did Warren Buffett auction off for charity in 2022? His car, a steak dinner, a lunch meeting with him, or his handwritten notes about investing and trading? Which one was it?
Oh, his car. What is it? His Cadillac. I think. I don't know if you've seen, but I actually highly recommend the HBO documentary from Warren Buffett. I think it was actually filmed around like 2018, 17, so it's quite recent. Did you know that actually Warren Buffett, depending on how the market opens, that's what he's going to get for lunch on McDonald's? So I think if the market opens down, he'll get like the $1 meal from McDonald's. If it's flat, like I think it's at $2, and if it's up $3, I actually don't know the price of that, but it's actually hilarious. And he drinks like how is it? Like 4 or 5 Cokes every single day, cherry Cokes. He loves them. But I've seen he actually auctions his lunch meetings really expensive. I think the guy actually paid like $500,000 for a lunch meeting.
Really?
So I'm either between a steak dinner or a lunch meeting. But I'm guessing he's more of a morning person, midday person. His car, I think he actually drives the same car since 1960. I think when your first kid was actually born. And
yeah, right. That's crazy.
Yeah, lunch meeting. Let's see what chat says. C, chat. Steve says also C. None of the above. His toenail clipping collection. Damn,
that's crazy.
Do people actually do that?
Oh, I don't know. You let me know.
No. You
don't act like you don't know, Luis. Come on. Don't ask me rhetorical questions here.
Absolute beginner says D. You know what? Gotta go with C. Locking and sending it with the chat and Steve agreeing.
All right, we can lock it in. You know, if the market opens up down, he gets one breakfast.
You gotta watch that documentary. HBO. It's on YouTube.
I think if it's been out for a few years, I think I might have watched it. It was very well put together, and it was cool to get like an inside look at the Warren Buffett. But this one is going to be a lunch meeting with him. Warren Buffett regularly, kind of like Grumpy Mike mentioned in the chat, but he regularly auctions off a private lunch meeting for charity. And a bid has gone as high as 19 million, which is absolutely insane. The amount of money people will pay to have, like, you hear the running joke, the one with Jay-Z, where they're like, would you rather have X amount of dollars or a lunch with Jay-Z? I know that one was going around for a while, but it is crazy to see, you know, if some people have the money, they will bid up to $19 million just to have lunch with Warren Buffett.
Oh, damn.
But no, we are coming to a close here. Good stuff, Chad. I know Chad got it right on both answers, and then we got a lot more answers on the second one. So maybe it's a more common thing than you would think. How much to go to lunch with you, Luis? How much we talking?
For free, man. Just get me inviting some tacos here. Not Taco Bell. Never been to Taco Bell, but here in the street.
How do you know it's not good? Oh, that sounds
man,
good.
I've seen those freaking tacos. Not even a real tortilla. It's like a crunchy tortilla made of. I don't know what the hell is that. That's not a freaking taco, man.
Hey, don't.
Whenever you come to Mexico, you're gonna get real tacos. You're gonna get eye tacos, brain tacos.
The first thing I'm doing to Mexico is I'm pulling up to a Taco Bell. If there's not one, I'm franchising one out there. No, I'm just kidding. Anything else before we head out today, brother?
No, that's it. It's a pleasure being here with you. Thank you for having me here. Good luck to everybody. Tomorrow's going to be playing earnings for Meta and Tesla. They're going to be definitely moving the market for Thursday morning.
Yeah. We'll see what we get, Luis. Always good chopping up the market with you, bro. And Absolute Beginner, Lone, Grumpy Mike, Chad, Steve, everybody else that was hanging out with us in chat. It's always a good time. Be sure to stay tuned for the next segments coming up next, and we'll catch you guys next time. Peace.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on tastylive.
Decision to build Thinkorswim was a byproduct or derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back? But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
If you missed the live show, here's our cherry on top weekly recap.
I have one question. Chicken wing, flat or drum?
Drum.
Sadno, we had it right. We knew it. We knew it.
You go for the flat part?
Everybody does. Everybody in the know goes for the flat. Nobody goes for the drum.
Well, first of all, I don't eat chicken wings, but if I do, I go there. Second of all, I go boneless.
Oh my God, you bougie SOB. Unbelievable. Unbelievable. Yeah.
Well, you didn't ask me boneless or bone.
That explains a lot on how you view the world too, by the way.
I told you 100% he's a drumstick guy.
Yep, 100%. Yep, I agree.
But I go
said
for
the same
boneless.
thing.
I would never order chicken wings.
Boneless. Oh my God, you're like a child.
I have never.
If they were in front of you and Tom, you would scarf the whole plate down. What are you kidding me?
I have never ordered a boneless wing in my life.
I guarantee you've had boneless chicken wings.
Yeah, I've had them, but I don't order them.
I would never order them. I like
when
bones.
you go to like a brown. Oh, you like bones? Oh my God. Well, because it gives you something to hold on to, like an animal. Go to boneless. This is a great conversation. Anything else you guys got?
Oh, Sosnoff, I ran into two guys from the floor that I haven't seen in forever. Magoo.
Okay.
There's a trader named Magoo.
Mike, MGU, Magoo, the nice guy from the floor. I mean, sweetheart of a guy. Hadn't seen him forever. I walk in to pick up some Italian food. There's a guy sitting at the bar with his wife and another guy and his wife. And he had a country club shirt on. I wanted to see what it said, and I couldn't read it, so I must have looked a little bit longer. He goes, hi. And I go, hi, but we didn't know each other. And then our eyes lock, Sosnoff. It was like it was like love at first sight. And I go, and he goes, Batman, I watch you every day. I can't believe I see you. He goes, you're a celebrity. I go, Magoo. And we sat there and talked for about 45 minutes. We had a great time.
While your family was back at your house waiting for their food?
Yes. I found some tapes from 40 years ago, Sosnoff. I have something that I would like to show you. And there's Mr. Tom Sosnoff. This is the last Papa shot he ever made. 31 years ago, you made your last Papa shot. You still got that Sissy Mary little thing that you do before you shoot.
What in the deep purple are you wearing?
A t-shirt. And a swoosh.
Hey, Scott, what if I said I could take you back to Sosnoff's prime 32 years ago? Would you like that experience?
From what angle? Like
a good angle. A good angle.
What prime? Like his trading prime, his basketball prime.
His basketball prime.
Love to see that.
All right, Beth, roll tape. Here is Sosnoff in his basketball prime. Can you see this?
You know what? This actually makes a lot of sense. Everybody's playing with their kid, and Tom's shooting hoops into a 3-year-old basket. Way to be engaged, Tom.
Get the full scoop by checking out the archives at tastylive.com. If you missed the live show, here's our cherry on top weekly recap.
You became Chicago's most eligible bachelor. What year was that? That was the debate we were having earlier while you weren't on the show to defend yourself.
1988.
88. So Vanetta was right. Late 80s, early 90s.
You mean when I was on the Oprah show?
Yeah.
Yeah. Well, 88. I had flowing locks like Tom.
Oprah just made it.
Oh, here it comes.
I mean,
she felt bad. She felt badly for him. You know, you couldn't get a date.
You get a car. You get a car. You get a Scott Sheridan. You get a Scott Sheridan.
I want the car.
That's right.
If you missed the live show, here's our cherry on top weekly recap.
You know, my first concert was when I was very young. It's quite embarrassing.
Anson.
How'd you know that?
I mean, I feel like everybody.
How did you know that?
Because who else was popular then in like the late 90s?
Oh my God, that's amazing. That was cringe. There it is, the song. Yes.
Yes. All right. Good luck. Good trading. Let's go eat some roost.
Peace.
If you missed the live show, here's our cherry on top week.
guys see a birthing room?
Birthing room?
Oh, yeah,
stop. Please
behind
stop.
JJ, is there a birthing room?
That's not a birthing room, you genius. Okay. Oh my God. Yeah, we have a whole birthing room. It's called. Oh my God, I think it's called a lactation room. Okay.
No, we have a birthing room. Hey, Tasty, we're delivering babies.
If you missed the live show, here's our cherry on top weekly recap.
First of all, I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And then he's still doing this.
Snow, let's take a look.
They did not hold that rally at all.
Phil, you got a partial.
973.75.
I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could like swivel his head. He has to see the screen. He has to go like this.
To me. And then, you know what? Money goes to money. You did it. Good job out of you.
Yeah.
I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on Tasty Live.
Welcome in Tasty CEO Tom Sosnoff, also founded Thinkorswim. Some call him the godfather of retail options trading. Tom, it's good to have you on. How would you be reacting as a startup founder to this news?
I'd be really pissed.
Yeah, as you should be, brother. I'm glad you said it because I can't.
And this is how we think as traders. You're much better off, instead of trying to follow the trend or follow the fundamentals, you're much better off playing the role of a contrarian.
And what I really want to do today is kind of break it out of that box and make it what it really should be, which is about understanding and thinking about probabilistic, predictable outcomes, about quantitative strategies. True financial literacy is about taking risk.
There's a very thin line between opportunity and risk, but where there's the most noise, there's the most opportunity.
The second you believe that somebody knows something and it's not you, then you're dead.
It was a great show. It was very inspirational and motivating.
I feel like you got to know each of the traders a lot better on a personal level. It was awesome.
This is my 10th or 11th live event. I thought the math was really complicated and it wasn't, and then it just made sense.
They've opened my eyes to many different strategies.
And I realized there's a reasoning and strategic planning that you could do to be successful. I love all you guys.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts. Some people say it's insane. That's what I do.
Wolf! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Christy Ross, St. Norbert College, Wisconsin. Number 85, because I like trades that have an 85% probability of success.
Lindsay Grata, University of Illinois at Chicago. Number 14, because that's how many times Tom asked me, where's my lunch?
Tom Sosnoff, State University of New York, Albany. Number 0? Really? You gave me 0 because I like being delta neutral?
I like the looks of that lineup.
Well, being mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
Looking for a better broker and a bonus? Sweet. Get up to $4,000 when you open and fund a Tasty Trade account. Plus, smart tech and a broker who's got your back at Tasty Trade. Make your move, genius. Tasty Trade.
Oh, yeah, it is Thursday, January 30th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, little podcast. Your little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And, man, do we have some incentives? And, man, do we have some people trying to govern the world? Whew. We could just go on in that. We don't have to talk about price. We could just go down that direction. Just insert Larry Ellison's future here, and we just go down that path. But we won't. At least not just yet. We should say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, go get them. But there's only one place to be a part of this. Did I get it? We did get it. There's only one place to be a part of that, and that's on the evil Google YouTube. So head on over there, find the chat, find the thing, find us somewhere. Do your best, and start typing. Just type. Just move those phalanges, smash your face into the keyboard. Do whatever you have to do, because you will spoof the Google algorithm into putting this show and the whole stream in front of as many people as possible. Yes, this entire 12-hour block of content. 12-hour block of content. So, without further ado, I should say what's up to the people. Shout out to everybody that you're already in the chat. Let's see. Tim Knight up next. No. I'm literally already here. Shout out to everybody. Dave S., Sunflower, Robert, so many of you in the chat. What's up, all of you? Hit the like button. Subscribe to the channel if you haven't already. Off and away we go, everybody. Is this week shaping up the way you thought it would? Is it? Massive Monday sell-off, and then basically scoopy from there on out. A little bit of a rotation finally today. A bit of a rotation. S&P 500 up 0.5%. The NASDAQ up just shy of 0.5%. The Dow Jones up a little bit more than 1/3%. And I think, have we been up 1/3% every day in the Dow? Something like this. The Russell was the outperformer on the day, up a whopping 1%. But this is something we've been talking about for a little bit. The Russell versus the NASDAQ spread. I had said something. What is a good day in the Russell versus NASDAQ spread? Expect around 50 basis points. That's effectively what you got today. So the Russell's done some work. I think on Monday we talked about this. The Russell NASDAQ spread was positive 200 basis points, or 2%, being fancy by using basis points, but it outperformed by 2%. And today you've got it about 0.5%, which is probably what you should expect. Today, a bit of a great rotation. I don't know if I should call it that, but a definite rotation, which is the trade I feel like most people are waiting on. Most people were waiting on. And it's finally given it up a little bit. Like in the summer, we flirted like we wanted to rotate into small and mid-cap stocks. And then all of a sudden, people start piling into big tech again. But we do have a little bit of a catch-up trade upon us. The utilities were the outperformer today. Go figure. Real estate up 1.3%. And I'm guessing that's just on the idea that bonds just kind of stopped going down. That's good enough. Utilities carry high debt levels. So generally speaking, lower yields are going to be net positive, price positive for utilities, because it makes the debt, quote unquote, less expensive. But, you don't really have a bond rally here. They just stopped going down, and that was enough, because a lot of these utilities, if you remember, early in the week, they got murdered, and they never came back. This read-through of the whole DeepSeek, NVIDIA AI story, the change in the narrative, this idea that these models could get more efficient, therefore the future energy demand, perhaps is not as great. That lasted all about 3 days. And people go, you know what? Probably need energy. Probably need it. But real estate being another outperformer, I think that has a lot to do with REITs. I think people coming around to this idea of buying some of these properties as income. Healthcare, the third outperformer. I've said that I'm going to go to my grave saying this going into 2025. I feel like there's a lot of value to be had in healthcare, and whether that's a regulatory spook, given RFK's potential confirmation here as Secretary of Health and Human Services, whether it's just the people that are burnt out and they're saying no thanks to, you tell me if I'm wrong. I don't want to go super political this early in the show, but I look around and I'm kind of like, hey, what do you think about the bird flu? And this is most people go, oh, shut up. Like they don't even want to, don't even bring another. Don't bring another one of these to me. I don't care. That's kind of the mood of the people I interact with. I had lunch the other day with a gentleman. He's a coach of a soccer team out here, professional soccer team out here. We're having lunch, and I go, what do you think about, because the first reported bird flu case in the United States, mRNA, Moderna's kind of percolating a little bit, up 10, 20% the last couple of weeks. I'm kind of interested in this topic. I also thought it's probably too cheap. I'm not proud to be a stock owner of Moderna, but I am. Same with Pfizer. And what do you think about bird flu? He goes, oh, shut up. Change the subject. Is that how you guys feel as well? Let me know. But anyways, healthcare, the third outperformer, I think on pure value alone, industrials, 1.3%. And, the underperformers here, everything was positive. All 11 sectors were just barely positive. But tech up 14 basis points in communications, where I believe you'll find some of the heavyweights like Meta, up 12 basis points. So, a big shift in the marketplace. It might not look like it if you're just looking at the majors, right? You just look at the majors, you go Russell up 1%, NASDAQ up 0.5%. Looks like an average day, but under the surface, if you go a little bit deeper into sectors, you'll see a more massive outperformance. You go a little deeper into industries, a little bit more massive outperformance, into sort of money flows and style factor preferences. It was obvious today that people had a reach for value. Is it day one? I don't know. This value trade has been a value trap. It'll work for, you get about 3 weeks, you get 2-3 weeks of a value trade, and then they just blow it up. But, it would be helpful for people like me if today was day one, because I go buy the junk. I go buy the dogs, and I wait on you for somebody to pop your FOMO bubble and go, oh shit, there's other stocks besides Nvidia, and then you come buying what I got. I'm waiting for that. Hopefully today was day one. The VIX at 1580, below long-term average, which sort of, I don't want to say it makes sense, but coming into the week, 14 and change volatility index, to me, did that make any sense to anybody? DeepSeek, right? Throw that to the side. You got a brand new administration. You got a bunch of confirmation hearings. You've got a big earnings season this week. You had a pretty dense economic calendar, not only domestically, but abroad. The idea that vol was in the 14 handle to me was crazy. And I'm not just saying this in retrospect. I brought it up on Sunday in First Call. So the spike up to, the 20s, maybe not that surprising, but the market sold it with the quickness. We are now back to 1580 just a few days later. That's surprising. To me, that's a market that does not have a lot of fear. That market does not have a lot of fear, man. And you can tell that, fear sort of concentrates in the marketplace in two different ways. It either sort of let me pull my poker chips off the table. Let me take my money, convert it into cash or some cash-like asset. That's like high level of fear. What used to also happen is you had, let me downgrade my equity exposure to low beta instruments. That's what used to happen. So maybe I take some money out of high growth stocks and I move them into, let's say, defensive sectors like a healthcare, something like this. I don't know. Maybe now that I think about it, utilities and healthcare are at the top of outperformance. That could be looked at as a defensive positioning. My point is, a money manager can't take your money and just move it to cash. So you and I can do that. We don't care. But a money manager who's taking 2% fees from managing your money can't move you to cash and just sit there, because the person on the other end is going to go, I'm paying you 2% to keep my money in cash. Are you out of your mind? Give me my money back. I can lose 2% on my own. So what they do instead is they keep equity exposure, but they downgrade to instruments with lower beta. But am I crazy, or is like recently? And when I say recently, I'm saying like maybe over the last 5 years or so, the low beta instruments have been the Mag 7. So it's like when people get nervous about the future, what they do is they go run to the Mag 7 as their sort of flight to quality. And I sort of get it. Most of them have respective monopolies or duopolies in their industries. Most of them have pricing power. Most of them are selling not just to domestic audiences, but have a diversified revenue stream across the globe. Most of them have super cheap borrowing costs, less than most Western governments, with central bank printing power and the ability to tax. So, I sort of understand how they act as like these quasi-equity bond, low beta, low vol instruments. And then what happens is, but the most interesting thing is when people get nervous, they go to the Mag 7. And because the Mag 7 makes up 30 to 40 cents of every dollar of the S&P, their fear ends up carrying the market higher. And then when the market is no longer fearful, they go for value, small and mid cap. But the act of leaving the concentration of Mag 7 when there is no fear has this diffusing effect on the market. It's the wildest thing. In other words, when people are fearful, they go to 7 stocks, and the concentration of those 7 stocks coupled with their high market caps and weightings of these index, they lift the index. When they're not fearful, they go towards value or risk. But the act of doing that leaves the concentration and puts downward pressure on the marketplace. It's this weird, wild, fascinating little seesaw thing we got going on. I don't know what you can do. I don't know what's actionable about that. I don't know how you play that. But I do think in some ways it presents an opportunity for a super two-sided market out at least into the next quarter or two. I don't know what resets that, but it is an interesting little dynamic we've got going on. And playing the two-sided range for people like me and likely a lot of you in the chat, that's probably an interesting dynamic to continue to be able to lean into and lean on. We'll keep cruising here. Oh, man. Something was wrong with my chat, so I wasn't seeing everything you guys were saying. My apologies. I just reset it. Now I see what everybody is saying, and I see all of you in the chat. My apologies. What's up, Absolute? Brian Watson, Uptick Loan, FM, Lincoln, Jason. Oh, man, the whole crew's here. Catan. I thought you guys were leaving me solo. I thought the chat was empty, but clearly my chat got frozen back on when Tim Knight's show. All right, let's keep cruising, baby. Now that I know I've got some active participants, I'm like, what is this? Am I being boring? That's also possible. With CS being the largest input, how do you see the U.S. being able to affect it if they can at all? I'm missing the context of that question. Help me out there. I'll come back to it. Chinese stocks doing well today. They are. I'm telling you, man. You guys can keep listening to all the Chinese stock FUD if you want to. But not me, bro. Not me. Look, I get it. I understand how difficult the road is ahead, but it seems like they follow the incentive structure. Are they going to let it all collapse? And if they do let it collapse, we're all going. You know what I mean? Like, the second largest economy is not just going to buckle with no. It's like, didn't we learn this in the great financial crisis, how connected our economies are? And while we might be trying to nearshore, onshore, and trying to minimize our dependencies in some ways towards foreign adversaries, if that's, I'm their words, not mine. We're not there yet. So if it's true that it's uninvestable, then what does that say about U.S. equities on a long enough time frame? If it's true that there's a lot of known problems with their economy, with their consumption, with their ability to navigate out of a difficult position without natural market dynamics and forces, well, that's probably in the price, my friends. That's probably in the price. But FXI up 2.5%. What's that Wall Street? The Wolf of Wall Street line. I'm not effing leaving. That's how I feel about my Chinese stock exposure. I'm not effing leaving. Unless they give me some crazy, if they give me another 50% lift in some of these underlyings, I'll lighten up just like last time and wait for a decent opportunity to reload. But I don't think people understand just how cheap these are relative to their U.S. counterparts. I don't think people understand it, but they will one day. My point is, if stocks are still going higher, I'm getting value here. If they're going lower, I'm buying the thing that they've already beaten up. That's kind of the idea. Chaz says, hey, Vic, I love you, bro. Love you too, my friend. Random ass characters. That's what I needed. Supposedly a decision tonight. Yeah. You'll get a potential catalyst. I don't think it'll be the catalyst the market is hoping for. I don't think that comes until March. To talk a little bit about bonds, I'll be short-winded on bonds today. But again, the idea is that bonds have stopped going down. Did we have some massive rally today? Not really. But since September, there have been very few days of reprieve. Maybe we strung together a week and a half of a rally in bonds in late November, early December. But other than that, maybe you get a couple of days of strength and then they just sell into it, man. It's, I don't want to knock on wood here. It seems like the bonds have found a little bit of footing at 110, which means the question becomes, what do you do here? What do you do around 115 level on a 5-point rally? Last time we got about 5 points in from 115 handle to a 120 handle, and they let them go. We get down to 110, rally into 115. What do they do this time? I don't know. Maybe it's not binary this time. Maybe we trade in a sideways range here for bonds for a little bit. But I think the rally in bonds definitely not hurting this guy. What is 2 thumbs up and not phased by a bond rally? This guy. Real quick, a look at your yield curves. Red line was where we were when we started these cuts. Green line on the second cut in November, blue line in December, and the yellow line is where we are today. Victor take on Chinese stocks. Oh, yeah, I just think, look, at some point you can tell me your bearish narrative until you're blue in the face, and I go, yeah, the market knows that. It's priced. You're not going to be able to tell me any part of the narrative that the market hasn't priced. It's discounted, bro. It is fully discounted. So now your question is, of the outcomes, of the standard deviation of outcomes that is known and discounted in this price, do we fall in the left tail, the right tail of that distribution of outcomes? Like, are you going to have an event that shakes the Overton window of how people are thinking about this? Or the potential outcomes, does it shift more towards the right or to the left tail? That's really what happens at this point. And I think there's more opportunity to shift to the right tail than the left. I think a move to the left tail is probably fat, right? If some very disappointing news on how they're handling stimulus comes out, sure, we could go from 32 FXI to back to where we were before this optimism started, or maybe even lower. But that's a known risk of $7 to the low side. I can handle that pain. And if you couldn't, you just figure out a way to mitigate that risk, right? You say, okay, what's my max pain I'm willing to put in on FXI? And I'm using FXI as a proxy, but you could look at Alibaba, Baidu, JD.com, Pinduoduo, all this stuff. Right now, most of those were retail. You might go tech. What's a good proxy for that? KWeb, something like this. But yeah, now most people are FOMO dabblers. Yeah. So the point is that 2 weeks ago, the narrative's horrible, and nobody will touch it. But now it's rallied some of this stuff from 27 up to 32.5, and now people want it. A couple of days ago, Nvidia's at 117. Nobody wants it. Rallies back up to 130. Now everyone's talking about it again. It's just like sometimes the hardest part of this game is you got to rewire everything to be the exact opposite of what they're saying. That's why on Monday, my advice to everybody, I don't say many interesting things, but I think on Monday, my advice was you got to turn everything off, mute everything. Because this whole industry every industry is designed around an attention economy. How do I get your attention? I make you feel something. I make you feel greedy. I make you feel fearful. I make you feel angry. All of this media apparatus is around making you feel something. And making you feel something is probably the death of your decision making at this game. So turn that shit off. And then just look at the screen and go, do I like this at 115? Do I like this in KWeb's case at 27? Do I like FXI at 25 or whatever we were just a few short weeks ago? Stop listening to people. They don't know. When the narrative's bad, they're going to tell you the bad narrative. But the point is the narrative's bad and the price is cheap. Which one of those two things matters to you more over the long term? Gold, my babies, at 28.52. Did we get a new all-time high today, I believe? I think so. Maybe not all-time high. We hit a high. 53.6. Massive little move to the upside. That makes me... That's never good. But, you know, that has a lot to do with, in my personal opinion, has a lot to do with the dollar move. But strong metals here today, both on gold and on silver's part. Silver making a move back up to 33. Give me just a second. Let me read some of your questions. I just buzzed by all your questions and comments, and I've just been doing my own thing. But this is a dance, baby. Let me see what you guys say. People don't care about cheap. They want stocks that go up all the time. Good luck. Vic, this is from Vince K in Iowa. Vic, tinfoil hat with me. Done and done. I had mine on. I keep mine on. Rezo. What happens if NVIDIA comes out on earnings and says fake news, they're still buying, actually still spending on steroids? That 118 looks cheap. I agree. I don't think that happens. Well, I don't want to say this. The rate of change on NVIDIA's beats has been slowing. It's still crazy. It's still eye-popping. It has been slowing, and therefore the rate of change of stock price performance post-earnings has also been slowing. I think the setup is here for just a business-as-usual report could be interesting to the market, more so than before, because, you know, we're trading at 150. Saying business as usual probably doesn't do much for your stock. If you're trading at 124, business as usual might be a sigh of relief to the marketplace. So I don't know. This is a more interesting setup. But Vince, I think this becomes NVIDIA is probably less about the quarter to quarter, and it's more like NVIDIA has the next 2 years of earnings that they've pulled forward, that they've estimated in a very positive light. They've pulled forward all of that revenue, because that's what a stock is, right? So a stock is all your estimated future cash flows discounted to some net present value. So the stock goes up crazy like this. What they're effectively doing is giving NVIDIA credit for all those future cash flows, and they're pulling that value into the present. Is one way to look at it. The other way is just saying I'm going to pay a higher multiple, but either way, it's all the same. So I think it becomes less about the quarter-to-quarter dynamics, to be quite honest, and more about sort of this long-term narratives that really change the trajectory of the growth expectations that have already been built into this stock, both on the upside and downside. I think quarter-to-quarter variation is going to matter a little bit less. And to be honest, I don't know, like a story like NVIDIA, I don't know that I'd be playing, do I think they're going to beat earnings or not? I don't think that actually matters. It's like Amazon. Amazon can come to the market, and the market can be expecting something, right? And they can come to the market and say, not only did we not meet expectations, your EPS expectations, we were negative. We had a loss. And this has really happened. And the stock can perform positively, because it's not necessarily about the X's and O's, right? The numbers. It's what did you do with that money? Oh, we built a ton of warehouses because we expect massive growth over the coming years. So we're preparing. So instead of just sit on the cash or reinvest it or buy the stock back, we use that money for massive capital expenditure. And the street is like, okay, that's cool. Do your thing. And I think NVIDIA might be a little bit like that. So I think trading just based on whether they had a good quarter, bad quarter, did they meet expectations, miss expectations. I don't know that I'd be playing that game. Just play cheap or expensive. You like the price here or not? You like the multiple or not? Anyways, but yeah, like at 118, on a short-term basis, it's easy to say now, but on Monday, you can check the tape. I said all the people who are cheerleaders of this stuff are now changing their tune, singing the death sentence, and pretending like they weren't cheerleaders last week. And I said, watch, when all these stocks have a 50% retracement from that sell-off, everyone's going to pretend like they weren't running around with their, like chickens with their head cut off. You don't believe me? Go check it. Because that's kind of what happens. And guess what? The stock stabilized, rallies up from 117. Everyone pretending like they weren't freaking out just a couple of days ago. But I would say that it doesn't look that strong. I'm actually surprised. I thought they could fill the gap at least. It does not look strong. Let's keep going. What else you guys got? The fix was in? I don't know about that. Any thoughts on home builders, construction, and industrials? So I am, you guys know, I was expecting, on the cut, I was expecting the long end to lift. And because I thought the long end would lift, I thought home affordability was going to get worse, which meant I thought a lot of the home construction stocks and home builders were too expensive. And it took way longer than I thought, but by December, all of this stuff took a massive haircut. So I got ITB. I have ITB on the screen. I keep telling my son, proper English. And now I'm saying I got. ITB is on the screen, and you can see this massive pain, this massive sell-off that occurred in December when people finally woke up and they go, I don't think mortgages are coming down. I don't think this is a fluke. I think the long end rates are going to stay here, somewhat elevated. But if XHB is your flavor, then here's another home builder ETF. By proxy, I think by proxy, I'm leaning a little bit long these home builders. I'll explain why. I want to get short the long end of the curve. I want to get short the 10-year and the 30-year. I just don't love the setup. I don't love shorting the whole, and I might miss the opportunity. I caught the first part of this move. I want to get back in it, but I want a decent entry point. For that reason, by proxy, I'm sort of long. I have long bond exposure because I want bonds to rally so I can get short bonds because I think we're going to 5%. So if bonds were to rally, which they have, what also does that mean? It means that longer term rates are coming down, that also longer term rates are tied to your mortgage rates. Mortgage rates are easing a bit. So if bonds rally, mortgage rates ease, what does that mean for, what does that mean for home purchases? And if home purchases look a little bit better, what does that mean for home building? I think there's a little room for a rally here, a trader's rally. But I can tell you, if I'm right, which who knows, flip a coin. If I'm right and bonds rally enough that people find it attractive to sell into again, then long term, I don't know, a lot of these home builders probably trade sideways to down. And you get some traders rallies here and there, but I still think, look, if bonds don't rally, if mortgage rates do not fall, I just think it's if people couldn't afford it at 5% rates, couldn't afford 6% rates, what makes you think 7% rates has made it any easier for anybody? And it's not like home prices are in some sort of deflation. Like, we're not in deflation. There are some hot markets like Austin that are correcting a little bit. But generally speaking, we're still seeing home price inflation. So home prices are going up, mortgage rates are not easing. That's still the case. That's still the environment here. And I think some of the things that I've been reading, I think the average time on market for a house is something like 2 months or something like that, which is a fairly long period of time, the longest since some date. I don't remember the date. So yeah, I would think, to me, the rally is already built into IDB and XHB. I don't know that I'd be chasing them here. I think if you can get another couple of points in bonds, if we get to 115, 116, 120. Here's the really interesting thing. I was thinking about this yesterday. Let's say growth gets weak domestically or globally altogether. In that case, there's going to be a run to collateral, right? People are going to want to buy into the long end of the curve, treasuries. But if they buy into treasuries, what's going to happen? That is going to bring down mortgage rates. So at the exact same time that people could be worrying about growth, mortgage rates could be coming down, making it easier for people to buy homes, which then, because they're buying a home, there's all types of durable goods purchases that come behind that, right? A new washing machine, a new heater, like big purchases. I need furniture, I need, whatever. So the really interesting thing about the setup here is if growth does become an issue, the offset to that is going to be that the long end of the curve is going to come in, unless we're in some sort of like stagflationary hell. But all things equal, you get the long end of the curve coming down with growth expectations getting muted, which then offers a little bit of stimulus back into the economy with cheaper mortgage rates, more people buying houses, more people buying shit to put in the house. So it's a really interesting setup here. They're in a decent spot. But the problem with these things is it never goes to plan. It's always the thing you couldn't model, you couldn't forecast, you couldn't see coming. That's the problem with these situations. But we just don't love to embrace the randomness. Brian says, Victor, I always enjoy your take on the market. Oh, that's scary. It's very kind of you, Brian, but just a scary thought, Scary thought that the opinions of a madman has any value in the economy, to me, is always it's mind-boggling. Does CPI really matter tomorrow in terms of market movement? Huh? Which calendar are you looking at, my man? Okay, I get what you're saying. You're saying PCE. So there's two different inflation numbers. There's CPI, and then there's PCE. They're all inflation numbers, but technically it's not CPI. It's called PCE, and that comes out in the personal income and outlays report tomorrow. Do I think it matters? No. It's one of the easiest ones for the market to forecast. There's not usually a lot of surprises there. And the market is expecting a pretty hot or a pretty warm month-over-month number already. Let me bring it up here for you. Boom, boom, boom. Refresh this bad boy. Come on. Is this? I think this is a refresh. Okay. So the CPI numbers are already out for December, but the PCE numbers are what are coming up Friday's release. So the December 2024 month-over-month PCE expectation is 0.3%. Last month, it was 0.1%. So the market's already forecasted a warm number. Core PCE expected to be just under 0.2%, which is, again, that's higher than last month. Last month was 0.1%. On a year-over-year basis, that's 2.6% year-over-year, which would be higher than last month at 2.4%, and the core at 2.8%. That's insane. We're almost at 3% again, and everyone's acting like inflation's not a problem. I will remind everybody out there, the target is 2%, which means, by the way, that means the goal is to ensure that your money has 2% less purchasing power every year. Just 2%. And that we're missing that goal. We're almost at 3%. So your dollar is going to buy about 97 cents worth of stuff in a year. Enjoy yourself. Sleep well. 2.8% core PCE, which would be on par with what it was last month. So my point is, PCE is the number that comes out Friday, and the market is forecasting a warmer number than last month already. Do I think it could cause a lot of problems? I don't know. If we come in any warmer than that, yeah, it probably will. But I don't know that that's in the cards. 0.3 is already a pretty warm number. If anything, I would see the probabilities to coming in cooler than expected. Like I would shift my distribution of outcomes to expecting a cooler than expected number versus a warmer than expected number. Most likely. That's my guess, but that's totally like finger in the air type guess. And what's that based on? It's based on if you were to plot out all the month over month changes, the amount of times you get a 0.4 or 0.5%, we've probably done that like a handful of times. We haven't done that much. And we certainly haven't done it since we've got out of those days of like 9, 8, 7% inflation. So I think there's the odds of going higher than 0.32, 0.35, that's super low. What's your opinion on crypto, Vic? I had a conversation with Tom earlier today, and it might have seemed funny, but I'll tell you why. So the first part of the conversation, the setup was Larry Fink was talking about tokenizing the marketplace. And he specifically said tokenizing stocks and bonds. So that I used that as the setup. But really, I read Vlad's, the CEO of Robinhood, I read his op-ed that was in the Washington Post. I believe it was on Tuesday or Wednesday, something like that. But my days are all screwed up because I'm a day ahead. So I read his op-ed in the Washington Post. I thought it was a pretty interesting op-ed. But the gist of the op-ed was that the U.S. sort of needs to embrace crypto technology. The practical application of the op-ed was we need to embrace tokenization, and in particular, we need to embrace tokenization with respect to private markets. Now, here's the you got to always, when you read this stuff, you got to understand that everybody has an incentive, right? You don't just read the news and like, oh, read it at face value. You understand the incentive. That Robinhood's business has gone from free stock trading to options trading to stock trading to margin to options to, I think, futures, and expanding globally. So at each point in time in their growth, they're looking for a new way to grow, to experience a new level of growth, to attract a new type of customer, to bring more assets in. So the lens you view this from is they are looking for new business opportunities. If I'm not mistaken, they contributed to Trump's inauguration fund. Somebody can check me on that, but I think that's true. And so when you do that, you go, what's a big ass? What's a crazy ask? What's the craziest thing that we can ask for that will move the dial for us from a business perspective? And plus also, what has a decent probability of actually working? Gary Gensler at the SEC is out. He's being replaced by a new head of the SEC who might be more open or amenable. I mean, if the president can launch a meme coin, what really is off the table? And perhaps they're looking at this and they're saying, they're saying, all right, if we can get tokenization, if we can get just a couple of changes, if we can get the laws changed on accredited investing, and we can get the administration to be open to tokenizing private issues, that's a insert market size here. They've probably done the math, and they see the market, the TAM, as some big amount of new investments, new capital, new activity to fuel their next phase of growth. So if I'm looking at this is I read the article and I go, oh, I see what you're doing. You're trying to move the dial politically and also move the social discussion around this. So you write the op-ed, you go and you do all these interviews, and you're trying to frame the discussion around this is in favor of the retail trader, that they're getting locked out of all these private companies as they grow, and the only people that are benefiting from this is Silicon Valley insiders and the rich. That's how you frame it. And so you get the people on the frenzy so that they go, yeah, I want this. This isn't fair. And then that puts additional political pressure on what you're trying to move. So I get all the moves, at least, and I might be wrong, but that's the lens that I see them operating through. But it doesn't mean it's bad. I just see the set of incentives. So let's frame this with a set of incentives, and let's go through the article. So now the article talks about OpenAI and SpaceX and all these companies that are worth hundreds of billions of dollars, and how the retail investor doesn't have access to that, and how there are half of the companies that are listed on public markets today than in 1990. In other words, more companies are staying private, they're not going public, and then retail investors don't have the ability to participate in that growth. All fair, right? All fair points. And so then, but the logical conclusion is we need to tokenize these private instruments, and we need to reform the accredited investor sort of rules. And if you don't know, in order to be an investor in the private markets, you have to be considered an accredited investor, which means you have $1 million in net worth, or you make $200,000 a year, or you're licensed in the industry, or you work at like an institution, like a big bank or an insurance company, something like this. And if any one of those four sort of areas you qualify for, well, then you're an accredited investor, and you would be able to invest in these companies. And if you don't meet those qualifications, well, then sorry, you're out of luck. You got to wait until these companies go public. There's a long way of getting to my point. My point is, I understand why it would be more beneficial for more people to get access to private companies prior to their going public. But I don't think it's so cut and dry. I ask myself, why is it that less companies go private? And why can't we either reform or deregulate our way into a world where more companies will go public earlier and give more retail investors access to those investment opportunities? I'm not saying that's the best path, but I didn't hear an argument as to why that's not the right path. And I can give you a few reasons why I think that wouldn't be argued for, right? That wouldn't be argued for by an individual company, because everybody is going to benefit in the industry is going to benefit from that equally. But if you're a technology savvy company and you have a high risk tolerance and you're willing to create a new business opportunity that very few other older brokerage firms are going to go attack, you're going to be a first mover. You're going to get first mover advantage. Therefore, the idea of new businesses rather than reforming existing businesses is more interesting to you. I'm getting to crypto. So what also happens is if you create the opportunity where all investors can invest in these private companies, and we just do away with accredited investor rules, which I'm not a huge fan of, it just means that our politicians are going to end up regulating or introducing legislation later on to the non-public market, to the private market, which means the private market, given enough time, is going to end up looking like what our public markets do today. So either way, you're going to converge on a world where you've got a public market and like a semi-public market or public market light. So it brings me back to my original question, why aren't we just addressing the issues with public markets to induce more entrepreneurs to go public versus hold or stay in the private markets? And but the point of bringing up that story, one, was to kind of go over it and see if you guys have strong opinions on either the accredited investor rules or strong opinions on not having, in many cases, access to some of these placements or some of these companies and having to watch them grow into these massive behemoths of companies that have already, like, by the time people got to invest in Uber, it had already displaced the taxi cab industry, the whole industry. It had already displaced it. So yeah, like the concept of our capital markets has always been, you know, if you need access to capital, you come to either the debt markets or you come to the public markets to raise capital, and then your investors get to grow alongside with you. That's not exactly how it's working right now. And I think we should ask the question, why? And perhaps try to fix that, then create these new niche markets, which then we're going to end up regulating again, because we've already run this experiment. We know all the problems that you're going to end up seeing, which is why we've put these regulations in place in the public markets to begin with. So we're going to run this whole experiment again in the private markets, only to find out, oh, we have to solve for this and this and this, and oh my God, we already did that. That's why we have public markets. But crypto is the technology that powers this tokenization. So what are my thoughts on crypto? I think we should be tokenizing everything. I think that's a sort of a separate conversation what I think about price, but I think we should be tokenizing real estate, equities, bonds, privates. I think we should be tokenizing everything because it minimizes risk for the participants and for the industry. And I don't think there are many downsides. There's going to be less jobs in financial services, I can tell you that much. There will be new jobs that will be created, but net, there will be less jobs in financial services if we get to the point where we don't need so many financial intermediaries to break apart the risks, because that's effectively what happens. Even though you buy a stock and something shows up in your account, that's all book entry. For a couple of days, it's not what it looks like. And because it's not what it looks like on the back end, the whole industry is managing a bunch of risks. And all of that managing of risk is adding costs to your experience. And as soon as we collapse all of that, a bunch of back office people are no longer going to be around, but a lot of costs are going to be going to be destroyed as well. So I think that is a good thing. The price of crypto assets, I think some of this stuff is dog shit. A lot of these meme coins are just dog shit. It's trading sentiment, and there's enough excess capital in our marketplace that people keep doing it. And we're going to trip credit, whether it's a year or 2 years or 5 years down the line, and all those meme coin traders are going to get wiped out. But they're going to play a game of greater fools until that point comes. Bitcoin, I'm not sure. I think I believe in Bitcoin. I think I believe in the scarcity of a digital asset, but not enough to put all my money in it. So I think I'm somewhere between 5 and 10% of total assets in Bitcoin, which is probably more than a lot of people, less than some. And I tend to think we haven't started with the Me Too games. We've got El Salvador. There's going to be more countries. There's going to be people that add it to, it might not be us creating a Bitcoin reserve, but other countries are going to create a Bitcoin reserve, or they're going to add it to their treasury. There's going to be more companies like Michael Saylor adding it to their corporate treasury. And I think we've just started to scratch the surface of that. And I think each financial crisis we get ourselves into from here on out, at first, it will be a painful experience, painful deleveraging for Bitcoin. And then because of the way our financial system is set up, there will be a huge a huge monetary response, which then means there's more money in the system being divided up against 21 million Bitcoin. Therefore, price goes up. I do think that the logic is sound enough that you're going to keep getting volatility. But I don't know that this thing goes away. And if you sit down, if you're somebody like me and you're like a prepper, right? And you just go, okay, how do I diversify my risk? Okay, how many passports do we have? What type of passports do we have? Where can we go with these certain types of passports? Where can we not go? Okay, where's our money? In what financial institutions? What do the clearing agreements look like? What's the insurance look like on those clearing agreements or on those brokerage agreements? And okay, what physical money do we have that's not in the fractional reserve banking system? The silver and platinum and nickel and gold. Okay, that's not as portable and transferable. If you've ever tried, I've tried. I got on a plane one time with like 15 bars of gold or something like that, and I flew through Dubai. And, they took me into this back room. Didn't seem like with much supervision. And it was just me and these gold bars. And these, people counting them in front of me. And I'm like, holy shit, this probably was not a great idea. I'm kind of at the mercy of like whatever these people say. And luckily I had good accounting of like, I knew what was in there. I knew the exact value and whatever, because they took the bag at one point and then came back and I had to account for it all. But the point is, it's not having your own money outside of the yielding fractional reserve banking system. It's hard. Where are you going to go? Also, if there's ever a situation you actually do need that money, what are you going to go hand in a gold bar? They're going to be like, thanks for the gold bar. See you next time. Why don't you walk out of the store there, guy? It's like, okay, I just lost one. So there are instances where I think there are practical applications. You put it on a thumb drive, nobody knows. You know what I mean? I like the idea of, a digital entry money where it's not, it's not out on loan. It's not my money's not being hypothecated and rehypothecated. I like that idea. And there's not many situations where you can do that. You throw it in Bank of America, and who is that kicked out Kanye West? J.P. Morgan, I think, threw his ass out. I don't like being at the mercy of other people. And so diversifying it in some way, sorry, I got lost. I'm saying there is a practical application for the use case here. There's not a big application. There's not big applications for Bitcoin yet. But it's not useless. That is for sure. So I don't know if that answers your question. I wish I could give you a direct price target, something like that, but that's not the way I operate. It's just like, do I think this thing is real? I think so. I think it'll be around for a while. And am I ready to put 100% of our future into it? No. But if the average of the people who are getting into it is like 1 to 3%, then I'll go 5 to 10. That's where my risk tolerance is. I don't know if that helped. Hopefully it did. Vince K. Vlad's take was interesting. This was the biggest argument for tokenization, crypto. It's actually happening now in some areas. It is, and it will happen. If you don't need to go public, why would you? All the damn filing requirements, all the scrutiny, stay private as long as you can. Kind of like college, stay in school. The real world sucks. Maybe, but that's the problem. You know what I mean? That is the problem, because so much of our whole system is designed around public markets. So if the majority of that wealth is created in private markets, well, that's like the amount of people that are going to benefit from that private market wealth expansion is it's a small club. There's less class mobility in that world. And I think the more opportunities for people, here's my thing, okay? If Tom brought up this point that most of these companies are going to fail, 95% of these companies are going to fail. Okay, what are the odds that if I go to the gas station, I put my money down on a lottery ticket, that it's going to fail? Is it higher or lower than 95%? It's higher. There's a 99% chance that money I'm flushing it down the toilet, especially if I play enough times and over a long enough period. So why are there no rules? If you care about means testing people, why are there no rules about how many times or how much money you can flush down the toilet in your lottery? Or if I go to a casino, right? What are the odds if I sit at a slot machine for hours or days and I just pump all of my income into it? What are the odds that I'm successful? Do I have positive edge in that scenario or negative edge? I have negative edge. And that's why Vegas looks the way that it does. Because you do not have positive edge when you go there. So why is it there's no means test to get in the casino? I just give you my ID. You say whether it's a real ID or not. You scan it and I'm in. Nobody gives a shit what I do once I get inside the doors. But when it comes to me putting some money, an Uber, which may or may not be successful, or, whatever, Joe Blow LLC down the street. Maybe you're right that my percent probability of a win is low, 95% or something like this. But the whole point of investors is they create these baskets where they want their IRR to beat the marketplace. And, if people are going to be flushing their money down the toilet, wouldn't we rather than be contributing that money as risk capital for entrepreneurs in the real economy than just like flushing it down the toilet in a lottery, or to build some new wing of a casino, or to buy some new Bugatti for some guy, some leadership, casino leadership? I guess that's my point. That a lot of the rules and regulations that are designed to protect you really just inhibit you. You can't trade options unless you have a certain amount of money or a certain amount of experience. Not at Tasty, but at other places. That's the way they play the game. It's like, who the hell are you to tell me that? Can't trade futures unless you do X, Y, and Z. This is my money. I can light it on fire inside of a casino, but you're telling me that I can't invest it as risk capital, or I can't trade it as risk capital? It's crazy. To me, it's crazy. And all this stuff that's supposed to protect people really just locks them out of the potential, volatility potential. And volatility is two-sided. It is both risk and reward. And the more we give people access to this, the less we stop treating it like it's some holy grail, and you can only come in here if you're wearing a tie and you went to some fancy school, and you know all these fancy words. Like I know a bunch of people who can talk that game, and then they come in, they try to do this, and they go, they didn't teach me any of this at school. None of it. because risk tolerance is a muscle. And if you give somebody access to a gym, they can go work out. And if you give people access to risk exchange, they can work out the risk muscle and become a better decision maker, a better risk taker. And that applies to all parts of their lives. And I just, the aspect of this op-ed I agreed with was how many stupid rules we have. But I could probably say that about a lot of things. That they don't protect anybody. They just, something happens and then they try to look good in front of their constituencies and they introduce some bullshit bill that ultimately doesn't do anybody any good. And that's why right now, most of you that have less than $25,000 in your account that want to be active traders have a hard time because you have some pattern day trader rule that they tried to implement after the dot-com bubble burst that made them all feel good, like they did something. And now all of us have to deal with the consequences, which is why I'm so glad that Tom and Scott are working really hard behind the scenes to get rid of these stupid rules. Because they don't do anything. I don't say all of them, but a lot of them don't. Oh, I just realized I had this in front of all of you. Hidden behind it's for your own good, exactly. All right, I'm sorry, I went pretty deep in that one. Gold has been tokenized on Pax USD. I know, but like, here's the problem with gold. So this is always the problem with gold. Okay, you've got gold. This is your physical money, and it's your money outside of the fractional reserve system. Okay, now you got gold, but it's hard to transfer. And if you got enough of it, what are you going to do? Store it in your house? How do you protect it? You got to get some guns or security, whatever. Build a vault. Okay, let's say you build a vault. Then you realize I built a vault. My neighbor built a vault. The pastor built a vault. I don't know. Why don't we just share a vault? That way we spend less money on securing this and building infrastructure for it. Let's build a vault together. Oh yeah, that's a good idea. We'll spend less money on this. So you build a vault together. You have one security. Now you got one person running the vault. That one person running the vault is charging everybody a little bit for rent and security. Then all of a sudden that person gets this genius idea that, hey, I can lend out some gold to make a little bit of money on interest, and all these people I'm watching the gold for, they're not going to know. And that's how you get to receipt money, which is how you get into fractional reserve. So the problem with, I think, tokenizing gold is you got to put it in one place, and then you got to believe that there's only one claim on the gold. So that it's harder to prove the digital scarcity. The great thing about Bitcoin is you can prove the digital scarcity. When you tokenize gold, I don't know, I'm sure there's probably some solutions to this. I haven't looked deep enough. But I think it's the same thing that always happens to gold, is that it's hard to prove that you have the same amount of claims on the gold as you have of the gold. That's probably the issue. But I don't know. All right, everybody, that's going to do it for us. Hopefully you got something out of this. I'm just kidding. I write these notes for the show, and I never know how it's going to go. And the reason I never know how it's going to go is because the wild card of this show is always what you guys ask, and then how many asides I'll take during the show based on your guys' questions. And so I think that makes it fun. It makes it fun for me, and hopefully it makes it a little bit more useful for you, at least the ones who join live. If you're watching this on demand, I appreciate it. Do me a favor, hit the like button, subscribe to the channel. Follow me personally on Twitter if you can, at Victor Jones, Owen Jones is 0, because I like to be difficult. Some people hit me up and they say it's hard to find my content now. I get it. So I'm working on something in the background. Hopefully I'll launch a YouTube channel pretty shortly to make all the content I create a lot easier to find. I don't know why it's been made hard to find, but it is what it is. So follow me on Twitter for more announcements, at Victor Jones, Owen Jones is 0, because I like to be difficult. I appreciate each and every one of you that chooses to spend some time with me, whether it's one day and whether it's 5 minutes or the whole 90 minutes. I appreciate all of you from the bottom of my heart. For those of you that celebrate the Lunar New Year, the Chinese New Year, Gong Si Fai Chai or Gong Hai Fat Zoi. We'll see you back here. This is Synthetic Friday for the show, so we'll see you back here on Monday for the Price of Truth. But if you're a degenerate like me, I will see you on Sunday for First Call. All right, we'll see you. See you, folks. Peace.